Okay, so we're going to start today. Today is going to be a very busy class. I want to do review problems first, so we're going to do our Chapter 9 review problems before we get into our taxpayer health situations. Chances are not good that we're going to finish everything today. It's a very, very full chapter, but I will do my best to see how much I can get through. We're going to be pushing pretty hard for this class and the next class, and I will make sure we're caught up in time. In the meantime, it is really important that you do as much reading ahead and as much practicing as you can, because what I'm saying is not going to make any sense if you haven't really at least read it over once before we get together in class. So do ask questions, participate a lot. If you're not clear on things, make sure that you're letting everyone know that you have some more questions. It is a tricky chapter, but it is an important chapter. But again, we're probably going to take part of the chapter today, and we may finish the last bit of it up tomorrow. So with that, let's jump into our review problems first. These are the ones from last chapter. And I'm going to go back one, and we're going to do chapter review problem 9-1 first, if it will load. Right, so maybe still having a few technical issues today. There we go. Okay, we have it. So this was our first chance to practice a full return with a family involved. In this case, we have some children and we have some spouses with varying incomes. So our first opportunity to really look, especially I'm going to say at the provincial forms, because you're going to notice a lot of things on the provincial forms are important when we get to families. We have Tony and we have Sandra, and they're married. Oh, 1 second, hold on. Oh, still having a technical challenge. We've got to get it up on the screen. Give me a moment here. Let's try that again. Oh, good. Much better. That's why we have a moderator to tell me when things are not working. All right, I'm going to hope that the technology just calms down and decides to let me do my job today. Let's see. If not, we're going to make this work anyway. I have whiteboards, but I think, yeah, hopefully it does. Oh, especially because I have some things I want to do. Anyway, we'll make this work. All right, try this again. We have Tony, we have Sandra. They're married. They've resided at their current address for several years. They have 3 children. We have Jason and a birth date, Stephanie and a birth date, Avery and a birth date. Those birth dates are important because they will determine different amounts of Canada Child Benefit. So we have to make sure the birth dates of the children are in correctly. For your tax return, you're not going to find a place to put them at the moment, but when we do data entry in the computer side, it will be important. Okay, and Tony works as a teacher at a local secondary school. He spent $1,800 out of his own pocket for school supplies. He wants to claim them on his return. If you're not sure, make sure you review eligible educator school supply rules. In this case, we're going to limit to 1,000. Sandra volunteers part-time as a translator. They make charitable donations. Remember, we can choose who's going to get the charitable donations, so we're going to be thinking about whose return we're going to put those on. On February 5th, he made an RRSP contribution into his wife's plan. It is a spousal RRSP. Who will claim the deduction on their return? Tony, excellent. The contributor claims the deduction, so we need the contributor's limit, which we have, okay? So the important thing is who put the money in. Doesn't matter who can take the money out. The contributor must claim the deduction. So Sandra and Tony want to register for online mail. They both want to answer yes, and they don't own any foreign property. We have a T4 for Tony. He has a pretty good source of income. Sandra has no income at all. So my next question for you, who is going to claim the charitable donations? It is a non-refundable credit. Tony. If he's going to claim them at all, Tony is the only person who can use them. We could put them on a return and file a return for Sandra, but if we did, the government would say, thank you very much for claiming donations. You get exactly $0 for that. So make sure you're not wasting donations. You're thinking about where you're putting them. First question I'm going to ask is, should Sandra file a tax return? She has no income. She's had no deductions. She's not going to get a refund. Okay, Helene, Bo, Ian, everybody says yes. And Marisa, yes for child benefits, yes. If they don't, if Sandra does not claim or file a return, the family will not get Canada Child Benefits. So the only way for that to happen is to file a return. So we're going to do both. We're going to file a return for Tony and we're going to file a return for Sandra. Sandra's return is going to be very simple. It'll be the easiest return you've done ever because it's going to be what we call a nil return, a return with zeros all the way. Okay. And we're going to talk about personal amounts. Personal amounts for the children is important. So I want to make sure you're clear on when I say personal amounts versus claiming the children in general are two different things. Can Tony claim the children? Yes, insofar as the children are dependents. If the children have medical expenses, which you're going to learn about that he's paying for, he can claim the children as medical expenses. He will get benefits for the children because the children are being registered as his children. But personal amounts are important. Personal amounts, we're talking about the first section of the non-refundable credits. And personal amounts means specific credits. Personal amounts will be a spousal amount. It will be a caregiver amount, those kinds of things. So in that case, knowing what we mean by personal amounts, can Tony claim any personal amounts for the children? No, there are no personal amounts for children now. One of the reasons we have this question in here is because there are a lot of taxpayers who don't really know how children show up on tax returns. And they may remember years past, because when I started doing taxes, there was a tax credit for children that fell into this section. So if you had children, you got a non-refundable credit for having children on your return. That credit has not been around for a while now, and yet everybody still thinks you get it. So you're going to have some clients who are going to say, have you claimed my children on the return? Point to where they are. Show me where the children are. And the problem is, we can't point to that anymore because they stopped making it a non-refundable credit. It started making it a benefit. Then they made it a non-taxable benefit, and now it's not on the tax return anywhere. So that becomes a conversation we have to explain to our clients a little bit. All right, how much can Tony claim for the school supplies he bought? He can claim up to $1,000. On what line? On the refundable line. Who should claim the child donations? We've talked about that. Let's take a look at their returns. We're going to spend a very short amount of time on the things you should already know and a lot more time on the provincial things, which I do need you to see. So let me go through very quickly here. We have his first page, married, English, Manitoba, and the important thing here, Sandra has 0 income. And Helene, Manitoba Family Tax Benefit, yes, the children will show up there, so that's a good point if they get it. So sometimes if you're working with tax software, it ends up being zeros, and then they're upset that it's a 0 because their income is too high, that even with the children, they don't really get very much. But yes, Manitoba Family Tax Benefit is a place where you can point to and say, look, I thought about your children there in the computer. More frequently, we will point out that they're getting Canada Child Benefit, and that will make them happy because that's a number that they can conceptualize it's money that they're going to get. All right, so we have Sandra, 0 income, so we're going to be doing a spousal amount for sure. Low income spouses, we think spousal amounts is an option. Income, very easy, he has a T4. Deductions at this point should be fairly easy. $2,000 RRSP, just a quick review of RRSPs. In this case, it's a spousal contribution, but it doesn't matter because it goes on his return. He's the contributor. So you need a Schedule 7. He put $2,000 in the first 60 days of this year, total contributions. His room was quite a bit, so he can deduct it. And when he deducts it, there will be none left over to carry forward. So it's a nice, straightforward schedule. All right, we have some pension, we have some union dues, we have some CPP. Make sure you're still doing a Schedule 8. We have net income of $64,438.50. And again, that RRSP, he's in the second tax bracket. He will be saving 20.5% if we collect it this year. It's not likely that next year he's going to be up a tax bracket, so might as well claim it now. It is a good deduction for him if he wants to have a deduction. We're going to get into the federal credits next. So we have the personal amount first. As we go down, we're remembering he has a spouse who has no income, so we need a Schedule 5. Schedule 5, we're going to do here. Marital status did not change, so we're going to leave that blank. Basic personal amount is the biggest one because he's in the lowest 3 tax brackets. Caregiver, I haven't taught you yet, but you're going to learn that one today. Spouse or common law partner's net income is 0. He will get the full credit. You have to do the schedule in order to get the credit, even if it's obvious what the answer should be. So I do run into this on paper returns sometimes. People will say, well, they had the net income as 0 on the first page, so why do I need to do the schedule? Everyone knows it's the max. The CRA requires the schedules. If you filed it without it, they would not give it to you. So there we go. Is Tony going to have an eligible dependent amount? While I'm here and I'm thinking about possible credits, can I do an eligible dependent amount? No. Excellent. Why not? What is the thing that makes him, so not because he claimed a spousal amount, although you're right, he can only pick one, but he has a spouse. If he had a spouse for the whole year, can he have an eligible dependent? No. So the very first test on your checklist is going to say, if you were married for the whole year, you do not have an eligible dependent. Full stop, period, ever. So this is one of those times where when you get into dependents and you're thinking about dependents and everything gets mixed up in your head, there are a lot of possible things that can go on a tax return. You have to start narrowing them down. So if I'm looking at dependents and I'm going, he's got kids and he's got a wife, can I claim the kids? And I say, let me see. Married for the whole year? No, there is not going to be an eligible dependent amount. Helene, can you claim both if you separated for 90 days? If you separated 90 days, you can pick which one you're going to claim, but you can't claim both, because if you claim a spousal amount for someone, you cannot claim an eligible dependent amount. That is one of the questions on the checklist. So as you're going through the checklist, if you were doing it line by line, you'd hit that line and you would stop. But it may be relevant. Maybe he has a spouse with a little bit of income, but they separated for 90 days, and for that 90 days, he looked after the children at least some of the time, and her income was low, so she doesn't need the credit. He would have a choice then about claiming an eligible dependent amount for the portion of the year they were separated, as long as he had the children with him at that time, and a spousal amount, but he can't pick both. Then the eligible dependent would be better, so he would pick that one. So you can see every time we start talking about dependent credits, all of a sudden we have to think about a lot of things. You might find it helpful if you're a flowchart kind of person to come up with a little flowchart and go, who are all the people he might have and what are all the things you might be able to do with those? If that works for you, if you're a very visual learner, it may be an option. Just sit down and kind of talk your way through as complicated a family as you can think of. Put a whole bunch of people in a household and see what you get. The other thing I'm going to recommend is do your review problems from this point on, because from this point on, you're going to get to practice them. If you're not doing your review problems, when you get to the final and you have to do the next assignment and theory exams, figuring it out for the first time on a test is not the way I would do this. You want to practice. We'll give you opportunities to do that. All right, so we've done the spousal amount. We know he can't have another dependent because at any point in the year, he was not single or separated or divorced or widowed. So cannot do eligible dependent, but spousal we can, and he's going to get the full amount, so that's good for him. Okay, back to the return. He's also going to get CPP, he's going to get EI, he's going to get Canada employment amount. When I add that all together, he's going to have total non-refundable federal credits of $32,638.49. 15% of that will be here. He still has some tax owing, so donations are valuable to him this year. We're going to do a Schedule 9. If you did your Schedule 9 correctly, should be $90.90, and you get total federal non-refundable tax credits. Use that to reduce his tax owing. He still has to pay some federal tax, but not nearly as much as he did a minute ago. At this point, before I do anything else on the return, do you think he's going to owe money, or do you think he's going to get a refund? So he's had one source of income that was his employer. He had an RRSP deduction, he had a pension deduction, he had union dues, and he has a spousal amount. I am also expecting a refund, and he had donations. If you're not seeing a refund, you may have done something wrong. I'm also expecting a good refund. So if it's like $200 or $300, I'll be surprised. I think it's going to be more than that. Just get an idea. And Brittany, yes, he didn't have any income that was undertaxed or not taxed. Lots and lots of deductions and credits. Right, that brings us down to the easy part, which is the federal. Let's take a look at the provincial. So I'm going to start with the family tax benefit. This will be the first time, if you've done one, that you actually get to use it. So let's see, we have a basic amount of $20.65 for him. He has a dependent spouse because on the provincial form, we have to make sure that he had a spouse there, but we know he did because her income was zero. So we only have to be careful for that one if her income is above the threshold provincially but below the threshold federally. Then we have to ask a question. In this case, if her income is zero, we know we have a spousal amount provincially as well as federally. So we're going to put $2,065 there. He doesn't have an elder dependent because he can't have one. Federally can't have one. Provincially, he doesn't have one. But he does have 3 children. So we're going to do amount for dependent children, 3 times 2,752. That gives total base for the credit of $12,386. And we have to reduce it by 9% of his net income. 9% of his net income is $5,799.47. We're going to put everyone in the family on his. There's no point putting them on hers. She had no income. She's going to have no provincial tax. She can't use a provincial non-refundable credit. We want to give him as many credits as we can. So family tax benefit, $6,586.53. Let's go back here and put that in. So we have second tax bracket again. Provincially, he gets the personal amount. For the spouse amount, it's a lower number than it is federally. Minus her net income, she gets all of it, or he gets all of it. CPP-EI plus the family tax benefit. If you forgot the family tax benefit, you're going to get a different number here, $29,422.02. And then we're going to do the provincial credits. Then we're going to do the donations and gifts. Donations and gifts, take the numbers from your Schedule 9 and put them on here, and you get an additional $58.14. Total non-refundable tax credits provincially are $3235.72. He's still going to be paying Manitoba tax, but not as much as he was a minute ago. At the end of the day, he'll be paying $4,322.59. Carry that down to the bottom of the page, put it back on the tax return, and we're not done yet because we have to remember there are provincial refundable credits as well that are tied to families. So provincial refundable credits, we have a $195 for him. We have $195 because he has a spouse. This one, we don't care if she's a dependent spouse or not. It's just she's a spouse. He gets to claim that he has a spouse. So $195 for each of them. They do not have an eligible dependent provincially because they can't. But they do have 3 children. Add $26 per child. The base credit is $468, reduced by $64,438.50. Still gets nothing, but it was a good exercise to do. There's another refundable credit on this form which you may have missed. Does anyone remember what it is? Why are we doing an MB 479 even though the personal tax credit is 0? What refundable provincial credit should we be thinking about? See if anyone got this one. It's going to be way down at the bottom of the form. Did anyone remember that there is an eligible teaching supplies expense provincial refundable credit? Good. You might not have. If you've been doing taxes for a while, this is new. This started in 2021. Did not have it before. And we haven't talked about it a lot. So if you forgot, make a little note when you're doing your credits. Go down the list of your provincial supplements textbook. I do not expect you to memorize this form. It's a long form. There's a lot on it. And a lot of the things on it, we're not even going to teach you in this class because it's not relevant. It'll be business related. But there are things that are. So your provincial supplement gives you really nice headings where you go down and you scroll down and you go, that doesn't apply, that doesn't apply, that doesn't apply. Oh, teaching supplies credit. That sounds like something I did. And then you check it and go, where does that go? Is it a refundable credit? How do we get it? And then you won't miss it. Okay. So I fully expected pretty much everyone to forget about this one, which is why we're doing this. So we do have an extra 15% provincial refundable credit. He's going to get $150 from the provincial government for his school supplies. And on his federal return, he's going to get $250 for the same school supplies, which is really nice for him, because that's going to reimburse him for quite a bit of those school supplies. Put everything else together. Total tax he needed to pay was $9,849.71. He definitely had more than that deducted. He is getting a refund. Plus the refundable credit federally, plus the refundable credit provincially, your refund or balance owing is $2,543.29. Okay. And then there will be Sandras return. Sandras return is going to look a lot easier. So for Sandra, we're going to have the first page, married. We need Tony's net income. We take that from Tony's return. We did Tony's return first to make it easy. Everything else on the return is going to be blank. So you're going to see nothing on the first page, lots of zeros. Nothing on all of these other pages. We can give her a personal credit, that's fine. We don't need it, but you can put it in. It's non-refundable, so she doesn't get anything from it. More zeros, more zeros, more zeros, lots of zeros, refund or balance owing 0. Her provincial forms are going to look the same. She still gets the base Manitoba Family Tax benefit for herself, but she doesn't need it, so fill out the form. Don't do anything with it. We've decided to give the provincial refundable credits to Tony because he's the one who had the eligible school supplies. So to get that credit, it has to be on his, and we're going to give it to him. And that's all. The reason that we're filling hers out is to get the Canada Child Benefit. So you did not need to do this, but if you were curious about how much they're going to get after they file her return and his return in benefits, the total entitlement for their family, estimated, because we never guarantee this because this can change throughout the year as budgets change and federal rules change and COVID happens and they give us extra amounts or change things. But the estimate of what she would get for 2022, based on her 2021 taxes, is $12,791.11. Okay. Good. That is that family. Are there any questions? If you did not feel confident in your provincial forms, that's why we're practicing them. If you're still not sure how I got my numbers, because I know this was fast, send me your forms by email. I will look through them, and I will send it back with comments. Okay, let's take a look at the next case that we had, which is Anita. In this case, we have a different family. Anita was widowed in a previous year, and Anita has a daughter who lives with her named Addison. Okay, so now we have a single parent. What dependent credit should we be thinking about when we have a single parent sitting in front of us? Every time you see someone who was a single parent at any time in the year, think eligible dependent. Excellent. And every time you think eligible dependent, my advice to you is pull out an eligible dependent checklist and use it. You will know some of them right off the bat, but you might miss something. So check anyway, because it reminds you to ask questions of your clients. So Anita, I know that there isn't another parent who's going to claim Addison, probably because she was widowed. So unless something else happened that I don't know about, I don't need to worry about someone else claiming Addison. And the other thing that I probably don't need to worry about is, unless we had told you in the case, someone else living in the house with her. But you might ask, because if you don't know that she lives alone with her daughter, you can say, how many people are living in your house? And she might say, oh, my sister lives with me and we split costs. And I will say, and does your sister have any dependents that they're claiming? Because if her sister is claiming dependent, she won't be able to. So use the checklist anyway. All right, in this case, we're doing eligible dependent for sure. So Anita lives with her daughter. Anita worked at the same job and lived at the same address for the past few years. She has some CPP survivor benefits. We'll have to add those on the return. And Addison has some CPP child benefit. Whose income will the child benefit be? So if we're doing a return for this person, whose return would it be on? Addison. We don't have to do a return for Addison necessarily. So we have to think we might need to. Remember, there's no minimum age for doing a return. But if Addison has no benefits, so based on Addison's age, there's no need to file a return to get benefits. Addison hasn't sold any capital assets, so we don't need to do a return for that. Addison isn't old enough to get GST and things like that. Addison isn't going to owe because Addison's income is so low that the personal credits will wipe it out. We're not going to be filing a return for Addison, but we have to remember that income is still there. So I want you to circle that income and think about how we're going to deal with that when we deal with dependent credits that are tied to income. All right. We also have RRSP contributions. We had $4,500 in the first 10 months, or the last 10 months of 2021, and $500 in the first 2 months of 2022. We have receipts, and there was a home buyer plan. Home buyer plan, she had withdrawn $12,000. $2,400 was paid back. How much does she have left to pay? So $12,000 taken out, $2,400 paid back. How much is left? $9,600. If she has to pay $800 back, how many years are left to repay on her plan? Just to see if you know how this works. Remember, it's always going to be even. How much is paid back divided by the number of years. So if we take 9,600 divided by 800, this is 12 years. 2021, 12 years. Next year, she'll have 11. I want you to keep that number in mind because we're going to use it, okay? And I'm going to write that one down because I did not do that. So we have 9,600 now out of 12. Next year will be out of 11. She's required to repay 800. She has some unused RSP contributions for previous years. Can I use those unused contributions as a homebuyer plan repayment? If she wanted to, could I? So it's a difficult question. Only the ones that were contributed in January, February of 2021. All of the rest of the unused contributions, no. So most of the time, unused contributions cannot be used as a repayment for a homebuyer plan or lifelong learning plan. You have to be careful with that. If you're carrying things forward, it doesn't mean you can use them in the future if you don't repay your homebuyer plan. They want to make sure you're putting the money back if you borrow it. So even if you've contributed more than you needed to in the past, that's not the same as paying it back by buying a new one. They do want you to buy a new one. If you haven't bought a new RSP, you have not paid it back, and it will still go back into income. So most of the time, unused contributions are not available as repayments for the homebuyer plan. However, in this case, she wants to designate $1,500. Can she designate $1,500 to her homebuyer plan? Yes, because she had more than that she contributed this year. So she can pick how much she wants to repay. If she repays $1,500, what will her required repayment for next year and all the future years be? So if she had originally had $12,000, now she has $9,600 left to repay. If she repays $1,500 now, and she has 11 years left after this year, her next payment will be $736.36, and that will be true every year. So by overpaying now, maybe she had a good year and she had some money, she'll have to pay back less each year. So that's one reason why people might choose to pay it back early, is I know I have the money this year, I'm going to put it in this year, I don't need that much deduction this year. Next year it might be harder for me to pay for an RSP, so I'm going to save myself a little bit, because next year if I miss that RSP repayment, I'll have less included in income. Right. So we're going to do a Schedule 7, and it's going to be a complicated one. We're also going to do some donations. She had 120 from Red Cross, 550 for Doctors Without Borders. And don't forget, she has a box 46 on her T4. You might have missed that one. On her T4, we have pension adjustment, but no pension contributions. That can happen. The employer can put money in and the employee doesn't. So that's probably what happened here. We do have union dues. We're going to claim those. We have a survivor benefit that belongs to Anita. And then we have a child benefit for Addison. You have to be careful here. Sometimes the tax slip will not be in Addison's name. Sometimes CPP Service Canada will have it in the parent's name even though it is going to the child because of how they have entered in their system. So if you see a child benefit for someone who isn't a child, you have to ask, who is this money going to? Whose money is it for? And then you have to make sure you report it correctly. Okay, so child benefit has to be paid to a minor. If the person whose name is on the slip is not a minor, it's probably their child's income. Figure out which child's income it is. All right, so will Anita be able to claim any amounts for Addison? We've decided that we're going to be claiming the eligible dependent for her, and we'll do how much on the schedule. We've talked about the home buyer plan. She has a carry forward of unused contributions, but from the previous year, we'll see if she has one for this year. And we're going to decide her donations as well. So let's just do all of that on the tax return. All right, so on the tax return, she is widowed. If she was widowed in the year, go get a specialist to do that return. I cannot stress that enough. In the year where that happens, there are a lot of things that need to be addressed on a tax return. Every year after that, it's a normal return again. Okay. What is her income? She has employment income, and she has CPP benefits for the survivor portion only, so it should be $4,320 there. Total income $59,320. Deductions, no deduction for pension, but we do need to do the RRSP. Let's look at the Schedule 7. So Schedule 7, she's going to have some undeducted contributions. She's going to have a contribution now and an additional in January, February. So new contributions for this year, $5,000. Total contributions available to deduct, depending on her room, $5,480. Then we need to decide how much we want to put. Be careful when you put a number on line 7. Go back and check to make sure she made enough contributions to do it. So you're going to go back here and you're going to look at line 2 and 3, see if there's enough there. If there is, you're done. If there isn't, and she's claimed more, and you're looking at unused contributions, you're going to have to go investigate what date those unused contributions were put in, because it has to have been in the 2021 January-February period to count. Otherwise, even though she wants to make a repayment, if she didn't make a repayment, she can't allocate it. So $1,500 here. That leaves $3,980 available to deduct because these portions she can't deduct, they're a repayment. Her room, more than that. So we're good to go for the room, $5,500. She can deduct all of that if she wants to, and she probably does. There will be none carried forward. Okay, there's our Schedule 7. That's not where I wanted to go. That's where I wanted to go. Union dues we're going to put on. So we have the RSP deduction is less than her actual receipts because she repaid her homebuyer plan. If she hadn't repaid her homebuyer plan, what would happen to the $800? If she decided not to repay it, where would it go? It would go into income on line 12900. It would be treated as if she took the money out of her RSP this year. So that's where it would go. We're going to leave that blank because she did make the repayment. In fact, she overpaid. She paid extra back, which is allowed. Okay, CPP, again, I'm trusting you all. If you need a review of that, let me know, but we have a lot to get through. So net income, $54,362.50. Taxable, she's in the second tax bracket. We're going to do a personal credit for her. When we get to the eligible dependent, we need to do a Schedule 5. So we're going to do a Schedule 5. And I know this is jumping around a lot. Eligible dependent is line 30400. We're going to fill it in after I get through all the instructions. And we have to fill it in here. So her marital status did not change this year, so we can leave the top bit blank. We need Addison's information. And we need an address for Addison because remember, Addison has to live in the same place that Anita lives in order to get elder dependent claim for her. They have to live together at some point in the year. So that address is very important. The year is important because if she's not a minor, a child will not qualify unless they're infirm. So we'll talk about infirm today, but the year is very important. And the relationship has to be child-parent, grandparent, grandchild, brother, sister. I think that's all of them, but if I'm missing one, refer to your checklist. Okay, so daughter is important on there. And then no impairment, because I haven't taught you that yet. Basic personal amount, yes. Caregiver, I haven't taught you that yet. Dependents net income from line 23600 of their return. She doesn't have a return. We're not doing a return for Addison, but if Addison had a return, that's what her net income would be. So that's what they mean when they see net income. If we were doing a return for Addison, what would be on that line? It's the child benefit from the CPP 3003.24. So we have to reduce the eligible dependent amount by 10,804.76. When I do that, I can go back and put it in the non-refundable credits. CPP, EI, Canada Employment Amount, donations, if you did the Schedule 9 is 175. Non-refundable tax credits is 4,568.20. Before I do anything else, do we think Addison is going to owe or have a refund? Expecting a refund. Remember, she had some income where some tax was withheld, but not a lot, which is the CPP income, but she had bigger credits than all of that and an RRSP deduction. So I'm expecting a refund. Should be a nice one. And we had donations. Okay, federal tax owing 3880.01. Provincial. Let's go through the provincial. I'm going to start again with the family tax benefit. Family tax benefit, you're going to put an amount for elder dependent on that line if there is a corresponding provincial credit. To make sure there's a corresponding provincial credit, you need to put the elder dependent amount minus the income. So because her income is below the $9,134, there is going to be an elder dependent provincial credit. If the child benefit had been higher, there might not be one. If there's no number here, we cannot put it on the family tax benefit. If that was the case, so let's assume the child benefit was $10,000. If the child benefit was $10,000, what would you put on the Manitoba family tax benefit for Addison? You'd put 0 on line 3, but what would you put elsewhere on this form? She would not have an elder dependent. Would she have a dependent child born in 2003 or later? Yes. So on line 9, you would have a child. So that makes sense. You'll notice if that had been the case, she would have gotten more. And the reason that they do that, the elder dependent claim is limited a little bit because you're getting a more valuable provincial credit already. So it kind of all adjusts out. Okay. But if there is no elder dependent claim, but there is a dependent child, then you put the dependent child. You have to do the elder dependent if there is one. You can't pick which you want to do and say, well, the child is more valuable, I'll do the child. If there's an elder dependent, you have to put it there. If there is nothing there, you would do dependent child instead. Okay? But in this case, we're right on the edge of getting a family tax benefit. So I hope you practiced it anyway. I would have done this one by hand because it would have been close and I would not have been 100% sure until I did the math. But there isn't going to be a family tax benefit in this case. So what we are going to have is an elder dependent amount, CPP EI, and that's it. 19,485.01 times 10.8 gives us 2,104. Don't forget the donations. Manitoba non-refundable tax credits 2,212.98. It's going to reduce her provincial tax down to 4,060.64. Then we go back up to the return. Total tax payable, federal plus provincial, is 7,940.65. Definitely deducted more than that. That's it. Again, because of her income, there won't be provincial refundable credits in this case. So we don't need to worry about that one. But we're still getting a very nice refund. Does Anita have to worry about an audit for the elder dependent? Do elder dependent claims get audited frequently? What do you think? Yeah, 100% they do. So the potential is there. And you can be audited 1 year and then left alone for a bit, and then 5 or 6 years later get audited again. It's a big refund. Most people who have elder dependent claims have nice refunds. And so the government does not want to keep paying people nice refunds without making sure that they're entitled to them. So the evidence you need to prove that your child is with you, it might be a custody order. It might be a written custody agreement. In this case, there isn't going to be a custody order because the reason she has custody of her child is that there is no other adult to care for her child. So that she would just need a statement to say, my child is still with me. If they want more proof, you can get proof of situations where there isn't anything in writing with third-party explanation. So a third party who's not invested in your family can give an affidavit or evidence saying this is the parent of the child or this person has care and control of the child. They're looking for things like a letter from the school, a letter from your child's physician. That kind of thing will also count. There's more information in the book on that if you haven't read it in detail. It is important to know what proof you need because these get audited all the time. So before we put an elder dependent on, we want to make sure that if it gets audited, they're going to be able to prove that their child is with them. Who has a harder time proving this, do you think, in Canada, women or men? Men. It's very frustrating. It is slowly starting to change, but it is very frustrating. There is still an inherent bias that if there are children and the parents are separated, that the person with custody will be the woman. That's not always the case. In fact, I would say often now it's not the case. Shared custody is much more common now. But you also see single fathers. Oh, Brittany, your mom didn't get audited and she claimed you for 10 years. Yeah. Widowed is more likely that they won't request very much, but sometimes they will ask to make sure that the child is actually still in the home. So again, there are some intrinsic biases in our system depending on your race or nationality. There are certain sections of our society that will be audited more frequently if they're single parents than other sections would, even if the reason they're single parents is because they're widowed. There are people who will be asked if your children are still in your house. And then there are people who don't get asked that question. So there is bias in here, and we have to make sure our clients are prepared and that we're supporting them in that. And Helene, the first year claiming separation, it will be audited for sure. Yes, in fact, in the first year claiming separation, very frequently the parents will actually have to file their custody agreement. We'll talk about that when we get to separation. All right, good. So we have Anita. Anita will also be getting Canada Child Benefit for Addison, not as much because of Addison's age. All right, I'm going to jump into the next chapter, see what we can get done, and then take a break because, like I said, we have a lot to do. I think we have some good momentum. Let's keep going. I will make sure we get some breaks today, but we're going to have to see how long they are because, again, we have a lot of material, and unfortunately, we're in Manitoba, and in Manitoba, we have this little problem of having a lot of refundable credits and a lot of specialized credits that show up on our returns that have their own rules. So I want to make sure you get an opportunity to learn those rules as well. All right, I'm going to start my slideshow. It's going to take a minute here just to get my screen cooperating. Okay, and one more. And what I am going to warn you about here is we're going to be sending you the slides at the end of the class, and Nancy will do that for me. But you're going to notice that the order in the package you're getting is not the order that I'm teaching it in. I like to teach this in a very organized way that works for me because I can explain kind of concepts and build on them. That is not the order it is in the textbook, and so it's not the order that it is in the slides. So if you get your slides and you go, I can't find the slide when you're watching the recording back, if you're watching the recording back, just, cut and paste them if you need to. They're all there. Everything is there. It's just in a different order. And then, as always, I have a few of my own things that I add, exercises and examples and things. But yes, if you're following along with the textbook, or if you're following along later on when you're studying with the slides, just know that I'm teaching it in a different order. I think this is going to help us get through efficiently with as little confusion as possible. So what I'm going to do, we're going to talk about health and tax returns. We all know on a tax return, you can claim lots of things related to medical issues. So just like with dependents, you have to think about all of the possible things that you could claim on a return and decide what applies and what doesn't apply. I'm going to start today with the biggest and strictest requirements. So you always go, if I can get this, that's great. If that doesn't apply, what comes next? So for today, we're going to start with the disability tax credit. Okay. A lot of people have the concept that people who are disabled get a tax credit on the tax return. Very few people understand, I say except for doctors, very few people understand how the disability credit works. So to get a disability tax credit, you have to apply to the CRA and have the CRA agree that you are the right type of disabled to qualify for the credit. If you qualify for the credit, it is $8,662 for 2021. This amount is indexed, so it does change every year. Don't memorize the number, but have a rough idea of what it is and know how to look it up. If you have a disabled child, it has the base amount of $8,662 plus an additional amount of $5,053 for children. That additional amount, just to make things confusing, is reduced by any child care that is claimed on the return. I'm going to teach you how to do child care later, or attendant care expenses that are claimed on the return. I'll teach you attendant care today. After the first $2,959. So you can claim $2,959 of child care or the same amount of attendant care and get the full additional supplement. Every dollar after that that you claim will start to reduce the additional supplement until the additional supplement is gone. The child will still get the base disability amount. Okay? This is one of those things that we forget when we're doing it by hand or when we're looking at a sort of big picture theory. So it is important to remember that there is a special rule for children and disability tax certificates, or children and disability amounts, and then just remind yourself to look at the worksheet before you finish, or read the form very carefully when you put the disability amount on the tax return. It tells you if it is for a person under this age. Use the worksheet to calculate it. Okay? You cannot claim the disability amount, so this is for anyone, if they have a disability and the government has said, yes, you have a disability that qualifies for this credit. You cannot claim it if you're also claiming attendant care more than $10,000. You can claim up to $10,000, but $10,001 equals no disability amount. And if you're claiming nursing home expenses. So we'll talk about what all of those are later, but if you're claiming expenses for a nursing home, any dollar of nursing home expenses means no disability amount. Okay? So in a scenario where you have a disabled client who needs non-refundable credits, they have income that requires them to pay tax, and that client has $11,000 of attendant care expenses and a disability amount, what would you advise them to claim on their return? What is the most valuable option for them? I could claim the $11,000, but then I don't get another $8,662. What if I claim $10,000 out of the possible 11? Then what happens? If I limit myself to $10,000 of attendant care, I had 11, but I'm only going to claim 10. How much will I get in total credits, broadly speaking? Then I will still get the disability amount, which is better than the $1,000 of medical expenses that I'm losing. On the other hand, if I have a client who's in a nursing home and the nursing home allows them to claim all of their costs and they paid $22,000 to that nursing home that year, which can happen, what's better? Limiting the nursing home and claiming none of it, or just $10,000 of attendant care, or claiming all the nursing home? claim all of it. So you're going to find when we get to medical expenses, whether we're talking about disability, whether we're talking about medical expenses themselves, all of the different options we have, you have a lot of choices that you can make. And those choices will all be correct. The CRA will accept them, but some will be better than others. If you know medical expenses really well, you will find money for clients compared to people who don't know medical expenses very well or people just using tax software. So spend some time studying on this. If you're interested in doing tax returns for people, spend some time with this chapter. It is, I find, a very creative chapter because I can look at one thing and go, where are all the places I can put that? And if I put it in those places, what happens? So that's exciting. For you as people who are new to this, it can be a little bit frustrating and stressful because it feels like everything is possible and there's a lot of moving pieces. So really, really do spend some time with it, and we will be giving you practice. We're going to be giving you practice now, and we're going to be giving you practice with seniors, and we're going to be giving you practice when we get to the tax software as well. So we're going to keep coming back to this. All right, so we know there's a disability tax credit. Let's talk about how you get it. If you want it, oh, that's not what I wanted. There we go. If you want it, you need to fill out a T2201, okay? You fill out the first 2 pages. The rest of it has to be filled out by your doctor, and the person who will send it to the CRA is your doctor, or in some cases, it will be an additional medical practitioner. It might be an optometrist, it might be a physiotherapist, it might be a nurse practitioner, it might be an audiologist, depending on which section you're filling in. But the person who can say that you had a disability that meets the test for the disability credit, that's the person who's going to send in the form on your behalf. Okay. If the CRA agrees, they will write back to you and say, yes, you get the disability credit. If they don't agree, they'll write back and say, no, you don't get it. If you think you should get it, you can try again with more detail and see what happens. Sometimes they'll get it, they'll look at it and go, I'm not really sure, I need more information, and they'll contact your doctor or whoever and ask for more information. And eventually, when your doctor is not busy, they will write back, and then the CRA will look at that eventually and kind of go back and forth until they have what they need and make a determination. So processing of the form, it says on this slide, can take up to 6 months. Some people will get it after 6 months. Some people, it will take longer, depending on how detailed the doctors were, how straightforward the case was as opposed to how complicated it was. It's generally not fast. Okay, so on my slide, it says the T2201 should be mailed to the CRA before the tax return is filed. I agree with that. What I would say, I'm going to amend that to say the T21 should be processed before you claim the disability amount. Because if you have put in a T2201 for the first time and you're claiming the disability amount, they will not process your return until they have made a determination about the disability credit. Why might that be a problem? So if I have a client who is disabled and let's say a senior, and they have applied for it, it's going to delay anything connected to the tax return, which would include old age security, which might be all of their income. Or similarly, if I have a parent who has a disabled child and they don't have a lot of money and they have a lot of expenses, and I file the disability for the child on that tax return and it hasn't been processed yet, it's going to delay their Canada Child Benefits until it gets processed. And if they're lucky, that'll be 6 months. And if they're not lucky, it'll be 10 months. It might be 11 months. And they really could have used that money up front. So in that circumstance, what can you do? So you know they want the disability credit, but they need their money now. How do we do that? I would file the return without the disability credit and then ask the CRA to adjust for the disability credit. So I want to show you the form, and I want to show you a few things about the form. So bear with me here. There we go. So you're going to notice, I'm going to skip around a little bit, but I want you to notice there's a portion here on the second page that says previous tax adjustments. If you're the person with the disability, you can say, yes, please adjust my previous tax returns for all applicable years. So you file without the disability credit. As soon as they process the disability, they will say these are the years it applies to, and automatically the CRA will go and adjust all of your previous returns without you needing to do anything else. That's wonderful, because you're going to get as much money up front as you can, whatever you're entitled to without the disability. And then as soon as the processing happens, this is automatic. It is more difficult if you are not the person with a disability or the legal representative. If you're filing for a child, once the disability credit is processed, that's great. You'll get notification, but you will not automatically be able to adjust your return. If the child had income, they'll apply the disability credit on the child's return, but that's not going to help you if we're doing a transfer. We're going to talk about disability transfers. You can transfer disability credit from someone who has the disability to someone who's supporting them. If you want the disability transfer, you have to file an adjustment yourself, but that's easy to do because you get the notice saying my child has a disability or the person I'm caring for has a disability, and then you file an adjustment and you just have that verification in the CRA that says you are eligible to receive the transfer, and then they will do the transfer for you. So always do that if it's important for them to have access to their benefits and their income. And I will say most of the time it is important for them to have access to their benefits, their income, and their refund now and not later. Because again, you're filling this out for the first time, usually at a time when you're dealing with some pretty major health issues. So be careful about putting it on the first time. Once it's been approved, as long as it doesn't have an expiry date on it, you don't have to continue to reapply. And once it's on the record, you're going to find it. You'll see it on the notice of assessment. You'll see it in My Account. You'll see it in Represent a Client. And I don't know if you see it in Autofill My Return. I don't think you do. But in any event, you want to do Represent a Client. When you see there's a disability credit, as soon as it's on the record, you can put it in the return and you don't have to worry about any delays. Okay. So mail it to the CRA before the return is filed, get an answer back. And Helene says, find a doctor who's filled it out before. Yes, if at all possible, find a doctor who's done this before because it will speed the process up. There's nothing worse than having a delay because the CRA finally got around to your application, and then they went back to your doctor and said, I need more information, and the doctor took 2 weeks to get back to them because the doctors are busy, and then the CRA took another couple of months to get back to them because they're busy, and then they say, I still need more information. It's very frustrating. Make sure your doctor knows if they haven't done it before that they need to be detailed. I will say specialists do a good job of these because specialists fill these out all the time. So if you have the option of having a GP fill it out or having a specialist fill it out, and your concern is one that a specialist has the most information on, you'll usually find that that's a faster way. But find the doctor who you trust and who you work with the best as well. Okay. So what is a disability? For every time you see the word disability on a tax return, it means that they have met this test and they have a verified T2201 on file. So there are lots of people who identify as having a disability who do not count on a tax return as having a disability. Disability on a tax return means they have a T2201 on file. It has been approved. Okay? So how do you get one approved? You have to have a severe and prolonged mental or physical impairment. It has to last at least 12 months in a row, so not something that comes and goes or something that's temporary and short-term. And it has to make it extremely difficult or time-consuming to carry out basic activities of daily living. So this is one area where people get very confused. Having a disability for tax purposes doesn't mean you're so disabled you can't work. You might be so disabled that you can't work, and not qualify for this. It's very, very, very precise. So it has to meet the exact tests of this form. If they do not meet the exact tests of this form, it doesn't mean there's nothing we can do on the tax return related to the fact that they have a medical condition that they're dealing with. It just means anything that says disability will not apply to them. Okay? To qualify, you have to meet one of these tests. The first test is blind, and they have a very specific definition of blind that we're going to talk about. The next test is markedly restricted in at least one of the basic activities of daily living. They have a definition of markedly restricted, and they have a definition of basic activities of daily living. If you don't meet that test, but you are significantly restricted in 2 or more of the activities of daily living, or in vision and one of the other ones, then you will still qualify. I will say most people who have the disability credit, any people with disability credit qualify under the significantly restricted. If they may not make all the way to markedly restricted, but a lot of people will fall into multiple categories, and that's how they get the disability credit. Or the last one, you need life-sustaining therapy. So we're going to break all of that down. Okay. Blind means after you've used corrective lenses and medication and lasers and transplants and surgeries and all of the things, after all of that, your vision has to be worse than 20 out of 200 in both eyes. You could be completely blind in one eye and have low vision in your remaining eye and not count as blind on this test. So that's something that surprises everybody. Or you have to have the greatest diameter of field of vision. Field of vision is how much you see peripherally. So if you can see straight ahead but out of the corner of your eye, you might be limited. It has to be restricted to less than 20 degrees of vision, which is very, very narrow. Okay? And you'll see on the form that that's the information that the doctor has to fill out. So on the form, I'm going to come back when we talk about transfers to the first 2 pages. But on the form, they have vision, and they actually require you to say, what is the right eye? How can you count fingers? Do you have light perception? What is your field of vision in degrees? They do it for each eye. You have to meet the criteria to be legally blind. And then they'll ask for years. They'll ask if it's going to improve or is it going to last for 12 months? And is it likely to improve so that at the future they won't? And if so, when do you think it's going to be better by? Because once it gets better, they're going to take your disability tax credit away. And then this is going to be filled out by a doctor, nurse practitioner, or optometrist. Okay, so very, very, very strict test. If you're going to get it just on the basis of vision, that's the test you have to meet. Okay. The next one is where we spend most of our time. And again, we do not determine if our clients are disabled. So I want to really stress this. You cannot tell from looking at a person that you've just met if they're disabled or not disabled. You will not know if there is something that meets this test or doesn't meet this test. So one problem that we run into in tax is making assumptions about the taxpayer sitting in front of us. You may have a client sit down in front of you and they'll have a disability certificate and you'll say, I don't think you should have this because you seem fine. Please never say that. There are lots of conditions where you can look perfectly fine for part of the day, but you don't know what is happening at home the rest of the day. It is not up to us to decide. It is up to us to help our clients. So if you have a client who's having a lot of medical expenses, they're telling you that they're really struggling, they're having issues, or you have a client who says, I've heard about a disability credit. Can I look into that? Can I, is there anything I can do on a tax return? Tell them about this. Tell them what the tests are, and tell them go talk to your doctor about it. It is up to the doctor to decide if they qualify or they don't qualify. It is not up to us to judge people who have them and go, well, I don't think you should have that because you seem fine to me. Terrible, terrible idea. Please never do that. All right, but markedly restricted. Markedly restricted means all or substantially all of the time, 90% or more of the time, they're unable to do one of the basic activities of daily living, even with therapy. So that's after therapy and supportive devices and medication. Or it takes them an inordinate amount of time. Inordinate amount of time usually means just completely unreasonable amount of time. So 3 times longer than the average person. And of course, there's no such thing as an average person, but the idea of what would most people do. So maybe the activity of daily living is dressing. If most people can get dressed in the morning and it takes them, 10 minutes to physically put their clothes on, if it takes you 2 hours to put your clothes on, even with assistance, like even if you have medication that helps or you have, occupational therapy tools to assist you, that would be markedly restricted. Okay, so 3 times longer than someone who doesn't have the impairment that you have. That's markedly restricted. Okay. Again, a lot of people don't meet that test. So what is significant restrictions? It means 2 or more. You haven't quite made it up to markedly, but if you put everything together, it is essentially equal to someone who's markedly restricted in 1. So your day is impacted in your daily living by that much. So that's a really big test as well. And again, when we talk about what are the things that we're talking about for basic living, they have a lot of detail on that. So basic living, speaking. So do you have difficulty speaking? Do you have difficulty being understood when you speak? Do you only communicate with sign language because you can't otherwise? They'll have that in here as an option. And again, you're going to notice that different people will be able to fill out different sections. So for speaking, it can be a doctor, nurse practitioner, or a speech language pathologist will be able to fill this section out. Okay. Hearing, it can be a medical doctor, nurse practitioner, audiologist. They're going to want to know both ears because it's going to have to be both. Have they used devices like implants or hearing aids? And if they do, with the devices, how severe is their condition? They have 2 charts, and they've even made them color-coded just to help people out. Severity and frequency. So how bad is it, and how often is it that bad? And then their ability to understand someone in a quiet setting. And then inordinate amount of time to hear enough to understand a familiar person in a quiet setting. And then yes or no, substantially all of the time. Has it lasted? Is it going to last for 12 months? Has their patient impaired in hearing improved, or is it likely to improve to such an extent they won't be impaired? Walking, can they walk? Do they take medication to aid them? Do they use devices or therapy? Do they have a cane, occupational therapy, physiotherapy, all of those things? Okay. How difficult is it to walk? Is it an inordinate amount of time? Would it take you 3 times longer to walk a distance than someone without the impairment would take to walk that distance? So it's a very, very high test. But again, you might have some limitations in walking, but also some limitations in speaking or in hearing. So when you put them together, does that make it significant? Okay. And then we have eliminating. So this is all of your eliminating functions and what medications are you on. Basically, they want to know what have you done to fix it first. And if you've done everything to fix it and it's still not fixed, then you get the disability credit. Okay. And then we have feeding. Feeding is a tricky one. Feeding includes preparing the food, but not buying the food or storing the food, which if you've ever dealt with someone who has a disability that makes eating food difficult, you know that a big chunk of your day is like it's really hard to shop. And when you shop, it's really hard to put the food away. None of that counts. But if it's very difficult to cook the food and you need to cook the food, then that will count. And more often when they talk about feeding, they're talking about the physical act of eating. So is it hard to put food in your mouth, to chew, to swallow? Can you chew and swallow? Some people can't. Do you need other assistive things like feeding devices, gastro tubes, all of that stuff? So they're very strict on this one, and unfortunately it does not reflect all kind of types of disabilities. They have rules. We're stuck with those rules. And yeah, Brittany says you feel like shopping should count, and I agree. I have met a lot of people with disabilities where food is very difficult for them because their restrictions make obtaining food very difficult, and frankly very expensive, because one of the reasons we have a disability credit is because it is harder to make money when you're disabled, and life is more expensive when you're disabled. But they have their rules. These are the rules. These are the ones we have to stick with. I tell everyone, if you think it's not fair, go call your MP and get them to change it. You'll notice advocacy works when it comes to disability credits, because things have changed in the last couple of years due to very solid advocacy by a lot of special interest groups. Okay, so we've got feeding. Dressing is another one. Again, shopping for clothes does not count, but putting the clothes on your body does. Okay, and then mental functions. This is the section where they've made the most changes recently. So mental impairment, they had a very limited definition in the past. It has been significantly expanded in the last year. So this now includes whether or not they need supervision or support. If they're an adult, what type of support do they need? If they're a child, what type of support do they need? And then they've actually broken it down to adaptive functioning issues, attention, concentration, goal setting, judgment, memory. Again, I cannot stress enough, we do not help our clients fill this out. If our clients tell us in their client interview that they have someone who requires a lot of help and assistance and they're struggling with that, we have to think this might be a credit that applies to them and help them access it with the help of their doctors. Or if they ask us about it, we give them the forms, we give them some brief explanations, and we tell them, work with your doctor on this and see if your doctor can help you with this. Okay? So we've got all of the mental functions broken down in great detail here. And then there is cumulative effect. If that is true, you're going to say which of the things, if you put them together, how many of them are affecting them, and all of that together, does that result in it being essentially equal to having a market restriction in one? And then the last one is life-sustaining therapy. This, again, has changed very recently. So life-sustaining therapy has to support a vital function. The one that people think of the most often is dialysis. If you have kidney disease and you're on dialysis, you have to regularly go and get hooked up to a dialysis machine. It takes a big chunk of time out of your day. It is exhausting, and you have a lot of medications and recovery and things after that. Okay. The other one is diabetes, and this is where things have changed recently, because for a long time, having diabetes was not enough to automatically guarantee that you would be allowed to have the disability tax certificate. It depended on how much time you spent dealing with it, and it was a very high test, and a lot of people were not entitled to it. There was a lot of pushback from that particular community, and there have been changes. So the first thing you're going to find in changes is that if you have type 1 diabetes, that's the kind that is genetic, you're born with it. It's not something that develops over time. If you have type 1 diabetes, you automatically qualify for the disability tax credit. If you have type 2 diabetes, you do not. You have to go through and say, how much of the time am I spending managing my diabetes, and possibly what other areas is it impacting, but mostly how much am I spending managing that. And not everyone who has type 2 diabetes will qualify, but for now, type 1 does. The other thing that's changed, if you've done this before, if you've worked in this area, you used to need to have your life-sustaining therapy minimum 3 times a week. Now it's minimum 2 times a week. They've changed that. And the therapy has to be needed for an average of 14 hours per week. Therapy means something that is supervised by a doctor. So unfortunately, there are lots of things like insulin pumps where you require the insulin pump 24/7, and that means keeping it clean, making sure that it's functioning, making sure that it's charged, dealing with restrictions and all of those things, but it's not supervised by a doctor because it's attached to you and you go out in the world. That wouldn't count. Helene, radiation would count, yes, because you don't get radiation treatment without being under supervision of a doctor. And what's nice, and this is new, it is not allowed in previous years, but now it's not just the time you spend getting your radiation treatment, it's also the time you spend that is medically necessary for recovery. So they have accepted the fact that if you're on chemo or if you're on radiation, after you get out of the hospital, your life does not go back to normal. There is a portion of time that you're going to need to recover, and that portion will be allowed to be included. Okay, so they have some changes here. So recuperation after therapy is not allowed unless it is medically required. And if you have a doctor say that it is medically required that you recuperate for a period of time, then it will count, and that's new. And this is huge, and it's going to change things for a lot of people. Okay, so mostly that gives you very, very detailed, but still broad strokes. Go to a doctor. Go to a doctor and see. And then the certification, the doctor has to fill that in. And again, this gets sent by a doctor. Okay. It is important to remember there are lots of people with disabilities who do not qualify for this credit. And there are people who have things that are still allow them to be able to work. They can work, they can maintain a job, but they qualify for this credit. So you can't tell from looking at someone what is their scenario. They'll know with their doctor what the right answer is. All right, so we've talked about these slides. I'm going to go through them because I did them on the form instead. Life-sustaining therapy is new. There is also really good information about the changes between the old disability rules and the new disability rules on the Sierra website. If you're interested in this at all, go look at that. I think it's wonderful. They even have a chart telling you what now qualifies that didn't qualify before. And if you know someone who applied recently and didn't get it, if they applied before the 2021 middle of the year, I'm pretty sure the budget change went in partway through the year, have them ask them to think about reapplying, because if they didn't qualify under the old rules, they might now qualify under the new rules. The last thing I want to point out is disability credits can expire. So when you get your disability credit and they say, yes, you qualify, you might have a date on it. It will say you are eligible for the years 2021 until 2025. What happens in 2025 if you are still disabled, if nothing has changed with your condition? What can you do? Reapply. And reapply early. Don't wait for it to expire because it's going to delay things. If you have a client who has an expiry date on a disability certificate that's coming up, go get them to do it now before they run out, because you want it to be processed before they continue. Why might a disability credit expire? So what are some circumstances where you are disabled now but you won't be disabled later? You might get treatment that improves your situation. Cancer is a big one. I had a client who had epilepsy. Her epilepsy was severe enough that she qualified for the disability credit. However, the government said lots of people get treatment for epilepsy and it works. So they put a time limit on it and said at the end of that, prove to us you still have epilepsy. This particular client reapplied and got it once, but then after that actually went through a process where she was able to get a surgery that completely resolved her epilepsy. And after a year of recovering from brain surgery, which still made her qualify for the disability credit because recovery from brain surgery is a big deal. But after she had recovered from the brain surgery and had been seizure-free for a period of time, she had to report that her epilepsy was resolved, and they no longer allowed her to claim the disability credit. What is an example of a disability that is not going to have an expiry date? Can you think of a few? Yep, CP might be one. Anything degenerative, anything that gets worse but not better over time? MS might be one. Parkinson's is another one. Alzheimer's is one we see frequently. Amputations. So the funny story that I tell is disability has changed quite a bit since I've done tax returns. Originally, when they came up with the idea of the disability certificate, you automatically had to reapply every certain number of years. Everybody had to reapply. And there is someone who went to court to say, this is ridiculous. I'm an amputee. I do not have a leg. It's not going to grow back. Please don't make me keep filling out these forms. And the court said, that's reasonable, fix this, and the government fixed it. So there will be people who will have disabilities that will not expire, and they will say indefinite, and if it is indefinite, that's fine. Okay. Brittany, have I seen anyone come with rheumatoid arthritis? I haven't personally had a client with rheumatoid arthritis, but I know that there are people who have a disability from that is so severe that they would qualify, and medication, they've kind of run out of options for treatment that will fix it. I suspect things like arthritis, fibromyalgia, they may put expiry limits on that because they are hopeful that there will be treatment in the future. And if you have to just continue to say, yes, I'm still having problems, which is frustrating. If you've ever worked with people with disabilities, it's when you are feeling the worst, they make you do all the paperwork. When you're really struggling and you can't handle it is when they make you do it. But that's the system we have. So look out for those expiry dates and work with your doctor. You do tell your clients when they're working with a doctor, they have to be very honest about what their day is like. Because if your doctor doesn't know that you are struggling with the basic necessities of life, they can't put it on the form. It's heartbreaking in some cases. So I had a client who almost definitely qualified for the disability certificate, but he did not want to have a piece of paper that said he was disabled and needed help. He was at a place in his treatment where he just was not prepared to have that label applied to himself. He came to file his return with the parent. The parent was supporting him financially and in many other ways. We discussed very carefully about the fact that if he had the disability credit, it would be possible to transfer that credit to his parents, and there would be more money in the family to help him with the treatment that he needed because some of the things he needed were very expensive. And he was just not in a headspace where he was ready to have that conversation with his doctors and put it down on paper and say, I have a disability and I qualify for this credit, which is fine. It's his life. He can choose that. He did say, I might come back next year. And I said, anytime you want to, don't wait till tax season. If you want to, we can get you the forms and you can have that conversation with your doctor. And this is going to be a process. So there are people who really need this and would benefit from it who are not prepared to have the label because it is a label that is not always accepted well in society. Okay? But it is hard to sit down and put on paper and say, I can't do things that everybody else can do. And if you're not ready for that conversation, that's fine. Educate, give people space, and understand that it's their tax return and it's their decision. And it's a conversation they should have with their doctors. All right, I've said you can transfer disability amounts. If you don't need your disability amount, you can transfer it to your spouse if you have a spouse. Or you can transfer it to a person who is financially supporting you. To do this and not have it cause a massive delay in your tax return, you should be thinking about this before you file your T2201. So I want you to notice on the first page of your T2201, Part A is the individual with the disability. Part B, if you think you're going to want to transfer this to a spouse or to someone else in your family who qualifies, fill out Part B now when you file it. Because what they'll do when they process your disability, they will at the same time process whether or not they agree that that person is eligible to receive your transfer. And it will go on the record as well. So on the notice of assessment, it will say, I am eligible to receive a disability transfer from so-and-so for these dates. And then we can put it on the return without having any delays. Who can get a transfer? The spouse can get the transfer, or a parent, grandparent, child, grandchild, brother, sister, uncle, aunt, nephew, or niece who is supporting them. So I'm going to go back now to the idea of Bob and Adam. Do you remember Bob and Adam? Adam was 22 with a mental impairment. Bob was caring for Adam, and Adam needed a lot of assistance. This is a credit where if Adam qualifies for the disability credit and doesn't need all of it for his income, he can transfer it to his uncle. So even though the uncle wouldn't get an eligible dependent amount, he might get a disability transfer. To get it, you have to say your name and your relationship to the disabled person, your social insurance number. They don't have to live with you, but if they do live with you, that's going to help. Why would it help if the person is living with you? Remember, dependents, you have to be financially supporting them for what things? What are the things you support dependents with for the CRA to say, yes, you are supporting them financially? Food, shelter, clothing? Necessities of life. Food, shelter, clothing. They put it right on the form here. So if they're living with you, you are providing them with shelter. So right off the bat, you are more likely to be allowed to claim the transfer. If they're not living with you, it's a little trickier because you're going to have to prove that you are providing food and clothing or that you're paying for their shelter. So if you're not providing shelter, if their shelter is covered, maybe they had an insurance payout that pays enough to cover their living in an assisted living facility, but you're paying for their clothing and their food, you're going to have to give proof of how often you're paying for those things and proof that you're paying for it. What kind of proof would count? What sorts of things can you show if you're not providing shelter that would still establish a dependent relationship so you can get the transfer? Receipts. So I did this for a family where they were supporting someone who was living outside of the house, but they were helping them with basically everything else. And we just had like a year's worth of grocery receipts that made it very clear that this was supporting another person and not just the family size that they had. And clothing, shopping trips for clothing in their sizes and things like that. Establish a pattern of support. It doesn't have to be for the whole year. You have to have enough receipts to show that it is a regular thing that you are doing and that it is financially necessary. That person would not have what they need if you didn't do it. If you're lucky, you'll be providing shelter because that one makes it easy. You just say they're living with me and they don't pay rent. You are providing shelter. You are financially supporting them. Okay? Fill this out ahead of time. I cannot stress it enough. This going through on a D2201 is easy. This going through as an adjustment is a real pain of an adjustment to do because we have to have receipts, we have to have signatures, we have to have extra calculations of things. It's a very difficult adjustment after the fact to do a disability transfer and get this on record. So if you can, and you know that the disabled person who's applying might be transferring a credit, fill this in. And you can fill it in for more than one person. So in the case of a disabled child, they have two parents. The two parents might both be financially supporting the child in food, shelter, and clothing. Fill it out for as many people as you want to be eligible to claim the transfer. You can split the transfer between multiple people as long as you don't go over the maximum, but they have to be on file as eligible to receive it for that to get processed without delay. If you claim the transfer by someone who's not on record, you have to get the adjustment through allowing the transfer to happen first. So plan ahead. All right. How do you do the disability transfer for a spouse? You do it on a Schedule 2. So we're going to look briefly at a Schedule 2. I promise we'll take a break soon. We'll take a nice break. So you give it to a spouse on a Schedule 2. Let's look at what is on a Schedule 2 because it's not just this. It's this plus other things. We haven't looked at a Schedule 2 before now. This is the first time. We're going to come back to it when we look at students. Okay, and a Schedule 2 is where you put any amounts that your spouse doesn't need that can be transferred. So when we get to seniors, we'll talk about the age amount. Caregiver, we'll talk about today. This is for infirm children under 18. Pension, we'll talk about when we get to seniors. Disability amount. If there's a disability amount on their return, put it in here. And then tuition, we'll talk about in seniors, students. Then we have to find out how much their income is because they need to claim all of their non-refundable credits first. And after they claim all their non-refundable credits, whatever's left over, you get. Okay? So remember that non-refundable credits are applied in order. So that becomes relevant when we get into these transfers in terms of what you're deciding to put. So for example, you might have medical receipts and you want to decide who to put them on, but if they have enough non-refundable credits that show up before the medical receipts, there's no point putting them on that return because they're going to come off at the end. Okay, so this does that for you. You're going to take their income, if it's 49,020 or less, put the amount on of 26,000. If it's more than that, you have a calculation you have to do. They want to know your credits or their credits on the return, and then we do their adjusted taxable income, line 7 minus line 11. See how much they need. Anything left over, you can transfer. And again, that portion there, if you have a spouse, you transfer it to your spouse. Okay? If you don't have a spouse, you can pick who you're going to transfer it to. And it's a Schedule 2. And there is a similar provincial one that works exactly the same way provincially. Okay? You can also transfer it from a dependent if they don't have a spouse. And that you're going to transfer, it's a little bit trickier here. So you're going to transfer any dependent for whom you claimed an eligible dependent, or who could have been an eligible dependent if you were single and they had no income. So this will allow you to claim a transfer from someone who would be an eligible dependent, except you can't have one because you're married, or they would be an eligible dependent except their income was too high for you to get an eligible dependent amount. The relationship and the test between you is the same, but it does eliminate those two barriers. Okay? So anyone who falls into that category, they would be an eligible dependent except for those two things, or they are an eligible dependent. Or next category, parent, grandparent, child, grandchild, brother, sister, aunt, uncle, niece, or nephew, for whom you claim the caregiver amount, which I'm going to teach you next, or who you could have claimed a caregiver amount if they had no income and they were 18 or older. So mostly what I'm going to say is if you think you can transfer a disability and it's not to a spouse, go into the rules and see who can transfer it. And my favorite place to go into the rules, honestly, for this one is actually just the disability certificate itself, because it tells you functionally who you can transfer it to, and all of these rules just tell us how to get it connected to the return. Okay? You can only transfer things from a Canadian resident because they only get a disability amount if they're a Canadian resident. So they don't qualify if they're out of the country. If you're doing a spousal transfer, you do a Schedule 2 and you claim it on the spousal transfer line. If you're transferring from a dependent, you're going to do the calculation and claim it on line 31800. Okay, a couple more rules and we'll take a break. The calculation, if you're doing a not spousal one, is on the federal worksheet. You can only transfer the amount that's not needed by the disabled taxpayer themselves. They have to use their disability for themselves, their disability credits themselves first. Anything they don't need, once they get their taxable income down to zero, anything extra you can transfer. If you're doing an adjustment because you've had, let's say, an adult child who is disabled and they've applied for the disability credit, they may have adjusted their past returns. It will adjust all of their previous returns, but if they don't need their full disability credit, they will not automatically adjust the transfer because you have to ask for it. In that case, you're going to tell your client to come back to you once they get their T2201 confirmed and their adjustments. When their adjustments go through, you're going to sit down with the person you're doing the transfer for. You're going to take the information from the disabled person's tax return, calculate out how much they need. Whatever's left over, you're going to put on an adjustment on yours, and you're going to have to show most of Step 5, honestly, most of the Step 5 portion of the disabled person's tax return in order to verify the numbers that you're claiming for the transfer. So those are complicated adjustments to do because they take time, and you have to take the numbers from one manually calculate what's being used, see what's left over. And in that case, you're going to have two things that you have to do. You're going to have a statement from the person who wants the transfer saying, I would like to receive the transfer, and a statement from the disabled person or their legal guardian saying, I want to give the transfer to this person. Again, once it's on record that they're entitled to receive the transfer, you can do the transfer automatically without doing this. But the first year, you're going to have to do the adjustment. Okay? You cannot transfer to another relative if there is a spouse who is claiming any non-refundable credit for them except medical expenses. So if you have a disabled person who has a spouse, if that spouse is claiming anything on the return for them at all that is a non-refundable credit, you cannot claim the disability. The transfer has to go to their spouse. On the other hand, their spouse might have low income and not need any non-refundable credits. In that case, if they're not claiming anything, then you can. That's rare. Usually if there's a spouse, the spouse is the one getting the transfer. Okay? You can transfer it to more than one dependent. So it's spouse first. If the spouse is claiming it, nobody else gets it. But if it's not the spouse, then you can split it, but you can't split it by more than the total eligible to transfer. And they all have to be on file with the CRA as being eligible to receive it. All right, we're going to take a break there because that was a long start. So I'm going to give you a nice 10-minute break. Then we're going to come back and see what else we can do. We're going to do caregiver and medical expenses next. So we're going to come back. I'm going to say at 10:47. Okay, we are back. Let's get some check marks, see how we're doing. I know that disability is difficult, and I'm going to add more complexity to it by talking about what happens if they don't qualify for disability. What is the next credit we're going to look at? So let's talk about impairment. Remember I said there are lots of people who have medical conditions or medical challenges who do not qualify for the disability amount, but may still qualify for certain credits on the tax return. And we use the word impaired for that. So infirm or impaired, those are used pretty interchangeably on the tax return. Disability means they have a T2201 on file. Infirm or impaired means they meet this test. So an impairment or being infirm means you have a signed letter from a doctor, medical practitioner, doctor, nurse practitioner, someone in that nature, and they will describe what the problem is, when it started, and how long it's going to last for. Okay? It cannot be temporary. It has to be something that is prolonged and indefinite. For a dependent child, prolonged and indefinite, and the child must require extra care when you compare your child to other people's children. So sometimes we're asked on the tax return to do things that we're told for mental health reasons we shouldn't be doing, but in this case you're going to look at your child and you're going to say, my child needs more assistance because of a disability of some type, because of infirmity or an impairment, and other children do not need that care. Okay? If it's dependent over 18, then the reason that person is your dependent, the reason you are financially supporting them, must be because of their infirmity or impairment, and it must last for an extended period of time. So again, this is not, I got into a car accident and I needed help for 6 months while I recovered. This is something that is an ongoing, significant issue. Okay? So that's the definition, and you're going to notice that's much, much less strict than what we need for the disability tax certificate. Okay? How do they interact with each other? If you are disabled, you automatically also count as infirm anywhere on the tax return that it says infirm or impaired. If you have a disability certificate, you already meet that test and you don't need anything extra. If you don't meet that test, you can still be infirmed. So in that case, it can't be temporary, and you will need a letter from a doctor for that. Okay? So If you have a disability, you get the disability credit. You might be transferring disability credit, and everywhere else on the return where you have an option that requires an impairment or infirmity, you also qualify for that. If you don't, we have to eliminate anything related to disability, but we can look at the next set of tests, which will be anything that is infirm. Okay? And the first thing we're going to talk about that you get if you are infirm or impaired is the Canada caregiver amount. So again, people who've been doing taxes for a long time, this has changed since when I started doing it. There was a Canada caregiver amount set of rules when I took this course the first time, and there's a new set of rules now. We're a couple years into the transition, so people I think are getting used to it, but you may come across a client now and again who remembers the way it was done the old way and will be very confused about the new rules. And more importantly, I am going to stress this, if you're ever doing old year returns for people, so if you're doing prior year returns, you have a client who comes in and they haven't filed in 8 years and you're going back a while, don't assume that caregiver now is the same as caregiver before. You may have to do a bit of research to see when the rules changed. And in the earlier years, you have to apply the old rules, not the new ones. Okay? I'm just going to teach the new rules, though, because that's more than enough for today. So Canada caregiver amount calculated and claimed separately. There is a Canada caregiver amount of $2,295. You can get it for a spouse or common law partner or an elder dependent who's 18 or older. And in that case, you get a bump. So you're going to have those claims on your Schedule 5, and then you get an extra amount, and it can be topped up to a maximum of $7,348. So that people find that confusing. I'm going to try to show you how it works. And again, I'm going to give everyone at the end of probably next class, I'm going to give everyone a chart that organizes this for you a little bit. Okay. Other infirm dependents, people who are not an elder dependent and not a spouse, because you might not be one of those. Again, Adam and Bob, the case we had. Adam is not a spouse of Bob, and he's not an elder dependent of Bob, but he might be an infirm dependent age 18 or older. He's dependent on him because of his infirmity or disability, and he's over 18. There's a maximum of $7,348 credit for caregiver amount for infirm dependent age 18 or older. And if you have an infirm child, any child who qualifies as infirm, you get $2,295. That one is not tied to income. It's just a flat rate. So you're going to see caregiver written in a lot of places on the tax return. Hopefully by the end of today, but if not by the end of today, then by next class, we're going to talk about caregiver amounts on the provincial return, because in Manitoba, it's the same word. It says caregiver amount. The rules are different. Who gets it is different. How you qualify is different. So learn the federal rules. Get comfortable with the federal rules. When we get to the provincial ones, we have to change things up a little bit. Okay, let's go in detail. So we're going to start with the spouse one. This is very common. The spouse or common law partner amount on Schedule 5 will be increased by the Canada caregiver amount. And then you're going to look to see if there's a top-up. Okay, so let me find my notes on this. Okay, so the way I would organize the top-up so you don't get confused is I would say that you want to think about it as an amount that's added to other dependent credits first. So you're going to have a caregiver amount. If you have a dependent credit already, you're going to add it to that. Because those credits are reduced by net income, if it goes below a certain amount, then you're going to do the top-up. So it's going to be a three-step process. You know you have a caregiver amount. Go find a dependent credit first, add it in, if you can, if there is one. Then all of that will get reduced by income. If that income reduces it by too much, you're going to go to one more place and you're going to top it back up again. Okay? So the caregiver amount for spouse or common law partner is calculated in line 30300, and if they're doing a top-up, it'll be 30425, and we're going to look at that on the return. So I'm going to find my Schedule 5, which I haven't opened yet, but I will. And we're going to take a look at what this looks like. So we have a spouse. Basic personal amount goes here. Add in the caregiver amount. Add them together. And then you're going to put their net income. And you're going to find out if there's anything left over. If there is, it goes on line 30300. And if you think there might be a top-up, you're going to go down to the top-up section, and you're going to see what it does. And that is line 30425, which is the Canada caregiver amount for spouse or common law partner or elder dependent age 18 or older. It says you may be able to claim this if you had an amount on line 30300 or line 30400. Completed only if you put the caregiver in and their income is between these two numbers. So that tells you when you need to use the top-up. So if you had a spouse and your spouse had a caregiver amount and the spouse's income is between those two numbers, you need to fill in two parts of the Schedule 5. You're going to fill in the spousal amount with the caregiver, and you're going to fill in the top-up, and you're going to have two numbers on the tax return, line 30300 and line 30425. Hopefully that makes sense. Practice them. If you're not sure what the amounts are, have a Schedule 5 near you and just highlight that income threshold because it's between two numbers. If their income is lower, they're already getting the max, so we don't have to worry about it. If their income is too high, they're not going to get it. So it has to fall in that, and if it falls in that, then they're going to need the top-up. Okay, let's try the next one. So we've done caregivers if you have a spouse. Now I want to talk about caregiver if you have an elder dependent who is 18 or older. 18 or older matters. And Karina asks, this is only for people with an impairment? Yes. So you can only give the caregiver amount to people with an impairment. That's different. So it used to be you could get the caregiver amount for your parents if they were over a certain age, whether they had an impairment or not. That is no longer true. So that's changed. There has to be an impairment to get the caregiver amount. So spouse with an impairment or a disability, because a disability is automatically an impairment. Okay. Or we're going to do elder dependent 18 or older next. So if you have an elder dependent and they're under 18, you're going to do something different. But if they're 18 or older, you're going to add the caregiver amount by 2295, claim it on the line, and then see if there's a top-up. And if there's a top-up, you're going to claim the top-up on 30425. Okay, so again, I'm going to flip to my form because I think the form makes it the most helpful. Amount for an elder dependent, it's going to tell you if you're eligible for the Canada caregiver amount other than your children under 18. So if you have children under 18 who are the dependent, don't fill this in. But if they're 18 or older, add 2295, calculate your elder dependent amount. If you have an elder dependent amount there and the dependent's income is between these two numbers, fill out the top up, and you're going to have two amounts on your tax return. Okay. We'll talk about what happens if you have an elder dependent who's a child under 18. That's coming up possibly next. Actually, while I'm here, I'm going to see if I can actually find that information. Yep, I think so. So you're going to have other infirm dependents age 18 or older. They're not an elder dependent. They don't qualify as an elder dependent for whatever reason. Maybe because you were married for the whole year. Maybe because they didn't meet the relationship requirements. But they are your dependent and they are infirm. In that case, we need to know the relationship. And the relationship has to be child, grandchild, parent, grandparent, brother, sister, aunt, uncle, niece, or nephew. So, Adam and Bob. Adam is not an elder dependent. Can Bob claim a caregiver amount for Adam? Yes. Good. Because there is an uncle-nephew relationship, and it specifically says that relationship counts, yes, Adam is over 18, he is Bob's nephew, he is dependent on Bob due to an impairment in his physical or mental functions, and he is resident in Canada during the year. So because of those, he can claim the caregiver amount for other infirm dependents, which is calculated on line 30450 of Schedule 5. So we've got another section on our Schedule 5, which is way down at the bottom. It is the last one, and it's strictly tied to income. So his income has to be less than $24,604, and the max claim that he gets is $7,348. There isn't a top up here. It's just the straight caregiver amount tied to income. Take that number, put it on the return. Notice you can have more than one caregiver amount. You could have 2 people who you get a caregiver amount for, or 3 people who you get a caregiver amount for. You need to make sure you have enough Schedule 5 information to claim all of the people that you get a caregiver amount for. Okay, eligible dependent, you can only have 1. You can have a caregiver amount for more than 1 person. And lastly, I said what would happen if you have a child who is infirm under 18, whether they are your eligible dependent or not. Either way, if you have an infirm child under 18, child is the definition we learned of child. So they're in your care, custody, and control, legally or in fact. Okay? Under 18 at the end of the year, and they need more help and care compared to the same age because of a physical or mental impairment. That's the requirement for this one. In that case, you get a flat amount. It is not related to income. You just get a number for every child that you care for who qualifies. Flat rate, same for everyone. It goes on the tax return. So I'm going to show you the tax return. I don't think I've opened one of those yet today, so I'll open one now, and if I have, I've got 2. That's all right. Okay, so this one goes here. I'm going to go find my credits, and I'm going to find my caregiver amount for infirm children under 18. How many children are you claiming? You get 2295 for each of them. And Helene asks, what proof is required to get this? You need a medical note or a disability tax certificate. Okay? And the definition of impairment is what it was before. For children, they need more help and care compared to children of the same age. For other people, they have a prolonged, so I'm going to go back to the slide because I think it's easiest if you see it there. Everybody else, they are dependent. They require financial assistance because of an extended infirmity or impairment. So they are not able to do things on their own, and they require financial support for food, shelter, clothing, all of those things, because of their mental or physical infirmity or impairment. That is the definition. We're still stuck on financial support here. We have not moved into all of the other caregiving things you do, with the exception of dependent children, because they will have financial support automatically. If you have a child in your house, you are providing them with shelter. That financial information is already there. In that case, you don't expect minor children to be having income and supporting themselves yet, and so there's an additional requirement for minor children that you need to be doing other types of care that you would not need to do for a child of the same age if they didn't have an impairment or an infirmity. And again, I'm saying impairment and infirmity because I want to use the terminology that's on the tax return. I'm speaking to you as a class. I would never say to a client, is your child impaired or infirm? That would be incredibly insensitive. That is not a thing that I would do. You might ask if they have, first of all, they'll volunteer if they have a child who has a disability, or if they have a chronic illness, or if they have additional medical needs. They will tell you that in the terminology that is appropriate for them, okay? And you will work within that. When you're looking at the tax return and the rules to know what applies to what, on the tax return, if it says infirm or impaired, this is what I mean. If it says disabled, I mean a disability certificate. So I'm going to use terminology that I'm not a fan of because that's what's written into the Act. But I would never say that to a client. Okay. It says take a break, but we did that already. I want to talk about medical expenses. We will see how much of this we get through. Okay. I'm not going to finish today, but I'm going to do as much as I can. So we've talked about the big ones. We've talked about disability, disability tax credit, disability transfers. We've talked about caregiver amounts and all of the many different types of caregiver amounts there are and the different ways we calculate them and who qualifies for them. More commonly, and what we see definitely all the time, so those are common, but they're not on every return. A lot of people have medical expenses. You can claim medical expenses that you paid out of pocket for on your return. So first thing I'm going to say, it's not even on this slide, you have to have paid for it. If it was reimbursed by your insurance, you did not pay for it, you cannot put it on your return. That is important because sometimes you will have a client who will bring you a nice big dental receipt, and then you will notice that they have medical insurance. And you will say, did your medical insurance pay for this? And they will go, yes. And you will say, how much did they pay for? And they will say, all of it. And then you will hand them the receipt back and go, I can't use this. You did not pay for it. They paid for it up front, and then they got reimbursed. So in their head, they paid for it, but they got reimbursed. So the money didn't come out of their pocket. Okay. So medical expenses that you paid for yourself, your spouse, or your minor children, children under 18, you can claim, but you have to reduce it by 3% of your net income to a maximum of 2421. And Marisa says, can you claim the portion insurance doesn't pay for? Yes. So if insurance pays for 80% and you pay for 20%, you can claim the 20%, but you can't claim all of it. Okay, so you can't claim all of your medical expenses that you pay out of pocket for. You have to reduce it by 3% of your net income. The higher your net income is, the more you have to reduce your credit by. So generally and broadly speaking, if you have two people, one with high income and one with low income, which person should claim medical expenses? It's a non-refundable credit, but you have to reduce what you claim by 3% of your income. Always claim by the lower income person if you can, because you will get to claim more of the medical expenses. If I had $3,000 of medical expenses and my income is low, I'm only going to reduce it by 3% of my income. If I have high income, I'm going to reduce it by the maximum, which is $2,421, and I'm not going to get very much of those medical expenses. So if you can, claim it by the lower income person. What is a scenario where you would not claim it by the low income person, considering that it's a non-refundable credit that comes off at the end of the credits? So if my income is $10,000, should I claim a non-refundable credit for medical expenses? No. So if my income is so low that I don't need any more non-refundable credits, I'm already paying zero tax, then give it to the other person who can use it. But always start with the low income person because you will get more benefit from the same medical expenses. Okay. So those are the medical expenses paid for by you, your spouse, and your minor children. You can claim medical expenses for other dependents, so dependents who are not your spouse and not your children under 18, if they are dependents and if you paid for the medical expenses. So those are the two things. They have to be dependent on you for some financial support at some point in the year. If you're paying their medical bills, they are. So that one is easy. Okay. But you also have to have paid for the medical expenses. That's the tricky one. So you have to have actually paid for it. In that case, it is reduced by 3% of the dependent's net income, not by 3% of your net income, by 3% of their net income to a maximum of $24.21. Okay? You can claim medical expenses for any 12-month period that ends in the tax year. So it doesn't always have to be January to December. This is something a lot of people don't know. Okay? So you can't claim expenses twice. You can't claim for the same period of time more than once. You can't have an overlapping period between last year and this year. But if in the previous year you didn't claim any medical expenses, so 2020 you claimed no medical expenses, 2021 you had some medical expenses at the beginning of the year and one or two expenses at the end of 2020, as soon as I pick a date in 2020, I can count 12 months, so I can count 365 days. And if that ends in 2021, I can claim all those medical expenses. We're going to practice that so you see how it works. Pick a medical year. Make sure it doesn't overlap with a previous medical year that you claimed. So you need to make sure that you haven't claimed a later receipt on a different return. You're going to start with the most recent receipt you have available to you. Figure out what's useful, and you have a little bit of room to play here as well. So if you have a client who had a medical expense that they didn't need because their income was too low the previous year, but you can claim it this year, then you can continue to keep that receipt and use it this year. We'll demonstrate that. All right. Medical expenses for yourself, your spouse, or common law partner are claimed on line 33099 and reduced by 3% of your net income, or 2421, whichever number is smaller. Has to be claimed by the person who paid them or their spouse. So you or your spouse have to have paid for it. The expense has to be for you, your spouse, or your minor children. Very important that you do not mix up this line with the next line, which is medical expenses for other dependents. If the person whose medical expenses you want to claim is not married to you and is 18 or older, you have to put it on line 33199. This is a mistake that a lot of people make in this course, is you just pool all the medical expenses together and put them on one person. Why is that a problem? Why will you end up with the wrong number on the tax return if you do that? If the dependent has income, you have to reduce it further. Not just by your income, you have to reduce it by their income. You'll end up claiming more than you're allowed to claim. So I cannot stress this enough. You must keep these separate. Put the medical expenses for the family with the minor children in one pile. Put any other medical expenses on a different pile, and do not mix the piles up. And remember, there are two different lines on the tax return, and you must keep them separate. So if we look at the tax return down at the bottom, medical expenses come off at the end. So you have medical expenses for yourself, your spouse, your common law partner go here. Put your net income in, times 3%, reduce it by that. And if you have anything else, you need to use the federal worksheet for the other dependents. Okay, again, I'm going to say it one more time. Absolutely critical that you keep your dependents in separate categories and don't put them mixed up together all in one pile, because you're going to allow more medical expenses than the CRA will allow. And when they audit you, and believe me, they audit medical expenses. They audit these all the time. When they audit you, they're going to ask for your client to pay all that money back. Okay, let's talk about the 12-month thing. So I'm going to give you some examples. Okay, we have a 2021 tax return, and your client gave you a pile of receipts that have not been claimed. So none of these have been claimed on a tax return ever. Okay, we have a December 5th, 2020 receipt, January, April, October, December. What is the best choice to maximize what they can claim on their return? I'm going to give you some annotation tools, and I'm going to ask you to draw a line where you think we should separate things. So I want a line that separates out a 12-month period somewhere. Okay, you should now have annotation rights. Okay, and I'm seeing a whole bunch of people agree. We want to include December 5th. If we include December 5th, what is the latest receipt that we could put if we had more receipts? What is the latest date we could put on the 2021? If we want the December 5th one, the absolute latest date is December 4th of 2021. Excellent. So I can claim everything from December 5 to December 4 of the next year, and that's it. Good. If I do that, how much will I get? So how much medical expenses can I put on before I reduce it by my income? $1,473. Good. If I want to claim the December 10, I cannot claim this one. If I made that choice, if I just did the calendar year, what would happen to the December 5th receipt? Would I be able to go back and claim it? It's gone. It's wasted. I can't carry that one forward another year. I'm stuck with it. I'm assuming I didn't use it in 2020 because I didn't need it. But I could use it now. What will happen if I do it this way and I save the December 10? What can I do with that receipt? I haven't used it. It hasn't shown up on a return anywhere. I can use it next year if I want to. I am going to say, if you're doing this, you have to be careful to see what was claimed last year, especially medical premiums. So medical premiums often get reported on T4s. Medical premiums count as a medical expense, and they usually cover 12 months. The problem is, if I made a claim in 2020 for medical premiums, I have claimed for the calendar year, which means I will not be able to use the December 5th one. So if you don't need medical expenses, please don't put them on the return because it ties the hand of the next associate doing the return. They're going to be wasted. They're not going to help you. Don't put them on the return. If they had medical premiums, but not enough to use, don't claim them because I would then have the problem of not having the option. You can't overlap which years you're claiming medical expenses. If they had no claim at all in 2020, we're good to go. If someone put something on the tax return for 2020 that included dates after December 5th, we have a problem. All right, let's try another one. Okay. So same thing. Give me an indication with a line. Which receipts would be the best if you know that you have an option here? What option do you want to make? Okay, so we've got some people suggesting December 7th is a good one to keep. Then we have to decide between the October and the November one. I'm going to ask you, would you rather have $180 or $500? I would rather have $500. So in that case, probably I'm going to say, that's fine, the October one's wasted, we're never going to use it. I want to get more now. With one exception. If I know my client has large medical expenses this year already, I might save the $500 one and claim it next year. And that way I can get the $180 now and get the $500 next year. But if I don't know they're going to have enough medical expenses next year to make a claim at all, because probably they're not, I would rather get the $500 than the $180. You have to make the decision when you make the tax return. Think about your client. Ask them. It's March now. Did you have another big medical expense like the one you had in May before? If they say yes, and their income is going to be the same next year, absolutely, I'm going to save that $500 one and claim the October one to maximize over 2 years what I can claim. But in most cases, I would say 90% of the time, given these receipts, I'm going to look at these receipts and I'm going to say, I can't predict the future. I'm going to maximize what you can claim now. I would claim December 7th. What is the last date that I can put a receipt on the return for 2021 if I want to get the December 7th one? What is the very last date? What do we think? December 6th. So I can claim any receipt up to December 6th, but not over, and that will be allowable. And again, make sure none of these have been reimbursed. Helene, don't most clients go by the calendar year? Most clients bring you a pile of slips, and they're not sure which years and what's in them, and half of them are for this year and you can't use them yet. Most clients are not organized, and that's why they come to see us to do their taxes. I will have clients who will come in and they will bring me just a stack of things, and they go, I brought a bunch of tax stuff. What do you need? And I go through it and I go, okay, well, this is 2017, so I'm not going to need that. This was that. So the tricky thing for those clients is you do have to look at their prior return and see if they claimed any medical expenses, because if they did, you don't want to double claim them. But it's very common. You're going to have like a pile of those little tiny prescription receipts that you get, the little sticker-sized ones, and some of them will be for 2 years ago and some of them will be for this year, and they've lost some. I will say for prescriptions, you may not know this, your clients may not know this. If your client goes to 1 or 2 pharmacies regularly, ask them to get a report. So Helene, you've anticipated me there. Ask them for the pharmacist to print out a report for the year. And if you think that there's a previous year that hasn't been claimed, you can get multiple years from them. And then everything is in one place and they haven't lost them. And that counts as a receipt. You can use that as evidence on the return. Much nicer. But I have clients who insist that they're sure the pharmacist has missed some and they want me to go through their little pile of receipts, and I will go through their little pile of receipts because that's my job. And then I usually hand them 2 or 3 of them back and say, these ones are for next year, so bring them back next year. And I'll go through and I'll notice that they had one that they had every single month, but they didn't give it to me twice. And I'll go, are you sure you didn't have that medication in that month as well? And they'll go, no, I definitely did. And then I'll tell them, go back to the pharmacist, get more receipts. We spend a lot of time on medical expenses trying to maximize what we get for our clients. If their income is such that they can use them, so they have to have enough income to be able to, and enough medical expenses. So if they have income, they need non-refundable credits, that's good. If they have medical expenses, they need to have enough medical expenses to be able to claim them. If their medical expenses are low and their income is high, we're not even going to have this conversation. It's not going to be helpful on the return. All right, so receipts. You must support medical expenses by receipts. Most of the medical expenses you're going to see will be typical ones, pharmacy receipts. It'll be for prescriptions. Prescriptions are eligible. It will be for dentists. Dentists give really complicated, frustrating medical receipts with all kinds of adjustments on them. So those are fun to go through and make sure you're not double claiming things, figuring out who the work was done for and who paid it and that it was paid. So those are fun ones. You'll get eye exams or optometry, sort of prescription glasses, that kind of thing. Those you'll get receipts for. Those are common. Okay. Other things you'll get will be medical insurance premiums. They're usually reported on a T4 slip or T4A slip. Medical insurance premiums, again, I cannot stress this enough, don't put them on the return if they're not using medical expenses this year, because it will limit the hours that I can do. It's box 85 on a T4. I only know that because I do a lot of them. I can't remember which box it is on a T4A, but you can look that one up. Okay, so box 85 will be medical premiums. If you're claiming medical insurance premiums and you're adjusting for medical last date, that's what we call it for our software. If you're adjusting the tax year that you're claiming medical expenses from a calendar year to a different period, make sure you think about which months of the premiums you can claim and how many. Premiums often change midway through the year, so you may have one amount for certain months and one amount for later months, and you'll have to figure out how many months and on which dates they paid the medical premiums. You can get that information from their employer or from their pay stubs. So if anytime you're changing the calendar year from January, December to something else, and you have medical insurance premiums, just slow down and make sure you're claiming the right months. And then some claims require additional proof. It will require a prescription. It will require a letter from a medical practitioner. So when we talk about those ones, I'll point them out. And there are lots of things that count as a medical expense, and then there are lots of things that people think should count as a medical expense and don't. Oh, and Helene, your employers didn't use Box 85. If they didn't use Box 85, get a letter from them saying that you paid medical premiums, and then you can claim it. So as long as something establishes that this was medical insurance premiums and this is what was paid in the year, you're good to go. And then tell your employer to start using Box 85 because it's good. Gluten-free food for celiacs, we're going to talk about that. So let's talk about what is a medical expense. I want you to get this idea in your head. It's very important. Not everything can be put on a tax return. Medical expenses specifically have to be on the list. If it's not on the list, even if you need it for medical reasons, if it's not on the list, you don't get it. This list changes all the time. So I will give you an example. When I started doing taxes, you were not able to claim a CPAP machine as a medical expense. A CPAP machine is a machine you use if you're having difficulty breathing at night and you wake up over the night because of sleep apnea and you have a machine that you put over your face to help you breathe. That wasn't on the list. Because it wasn't on the list, it was not an allowable medical expense. Someone had to go to government and say, change the rules, please. Obviously, this is a medical expense. Nobody would buy one and pay for its maintenance. Otherwise, like, this is crazy. We're only doing this because we need to, and they've changed the rules since then. So you can't assume that it makes sense that it would be on the list. If you don't know, look it up. There is a complete list on the CRA website. I'm going to take you to it in a minute. Medical practitioner services provided by medical practitioners that you pay for, because a lot of things are covered by provincial insurance. But if you pay out of pocket for medical services, it depends on what province the medical practitioner is in, whether or not you can claim it. Doesn't matter what province you're in, it matters what province the medical practitioner is in. We're going to talk about that. If you're claiming it because it's on the list, you have to have on the receipt the purpose, the date, the name of the patient, and if applicable, the name of the medical practitioner. So prescriptions will have the name of the person prescribing it on the receipt as well. And then some medical claims, you also have to have a letter from your doctor to support it. Everything on the list will tell you what you do or you don't have to do to claim that receipt, what proof you need. Keep your records. We don't keep our records for our clients. We package it all up, put it in their tax package, give it back to them and say, don't lose this. If we did keep these receipts for our clients, we would need 4 times more storage boxes than we pay for currently. It's a lot of paper. Your clients can have scanned copies if they're legible. They do not have to be originals, which is nice. But most of the clients that I have who have a lot of medical receipts are not organized enough to do that. They just throw their envelope in a box somewhere and hope they don't lose it. All right, so where do we go to get medical expenses? CRA, the list is on the CRA. A partial list is in your textbook, but if you want to know for sure, go to the CRA website and say eligible medical expenses. And you should be able to get which medical expenses you can claim. And you're going to get a nice little table like this. And on this little table, it's going to have categories, and some of the categories will have extra rules. So an air conditioner is eligible with a prescription and extra rules. It's limited to $1,000 or 50% of the amount paid for the air conditioner, whichever is smaller, for a person with a severe chronic ailment, disease, or disorder, and you have a prescription for it. Other than that, air conditioner, no. Assisted breathing devices, remember I said CPAP machines? A CPAP machine is eligible. Maintenance to repair a CPAP machine is not on the list. So if you have to buy one, yes. If you have to repair one, unfortunately, right now, not on the list. You're going to notice that these categories are a little weird, so you may have to read the whole list in order to find what you're looking for. Gluten-free food for celiac Very, very specific. Only people with celiac disease. There are lots of people with medical conditions who cannot eat gluten, but they are not allowed to claim gluten-free food as a medical expense. If you are diagnosed with celiac and you have a doctor's letter saying that you are required to have a gluten-free diet because you have celiac disease, you have to claim the portion of your food that costs more than the average cost of not gluten-free food. So that one's really fun. You get to keep a chart. You have to keep all of your receipts for all of your groceries for the entire period you want to claim it for. Tell them how many months you bought, let's say, bread. How much is the average cost of regular bread with gluten in it? How much is the average cost of gluten-free bread? What is the difference between it? And that is how much you can claim. And you have to do that for every item on your yearly shopping list that has gluten in it. Really, really fun. I'm sure if you have celiac disease, you want to spend your time doing this. And yes, Brittany, there are a lot of people with dietary illnesses who have very expensive grocery bills who do not get to claim their grocery bills in any form on medical expenses. Another one that people think, lactose intolerance. If you have lactose intolerance, you either might need to buy lactose-free products or buy lactose pills to take the enzyme for it. That gets expensive if you do that enough to eat regularly, and it's not on the list, so you can't claim it. Not everyone can claim their medical expenses. You can only claim it if it's on the list, okay? Keep this list available to you because we're going to do a little bit of practice with it. I want to show you one more thing, which is the medical practitioners. So if I scroll down here, I'm going to find it. It's a long list. Medical services by medical practitioners. An authorized medical practitioner is allowed depending on the province they're working in. You can find this chart in your facts and figures book. So it's in your facts and figures book, figure 36. Let's say I want to claim a chiropractor receipt. If I went to a chiropractor in Alberta, I can claim it. If I went to a chiropractor in BC, I can claim it. If I went to a chiropractor in the Northwest Territories, I can't claim it. Counseling therapist, New Brunswick, if their classification is a counseling therapist in New Brunswick, yes. In Nova Scotia, yes. Everywhere else, no. Okay. Therapy, psychologist, yes, everywhere except the Yukon. And it is about where you get the service from, where the practitioner is, not where you live. Okay? Massage therapist. Massage therapist, Manitoba, no. Ontario, yes. So if you have a client who needs to go for registered massage therapy, if they go across the border and get their massage therapy in Ontario, they can claim it. If they get it done here, they can't because of the list. So you're all going to grow to hate this list. You're going to spend a lot of time with it. Let's do some practicing. Okay, so I've got a little annotation thing here. I would like you to, as always, on the left side say yes, it's allowable. On the right side say no, it's not. What can we claim? Medical insurance, yes or no? Yes on the left, right on the no. And if you're not sure, experiment with the list. We're going to talk about these together. Good, and I like when the extra notes go in there because some of these is a yes with an asterisk. All right, I'm going to give you a minute for that. Keep trying. Some of them you're going to have to look up. Give you another minute or two, and then I'm going to give you some answers. All right, I can see most of you have answered it. The one down at the bottom, don't miss the one at the bottom left that says supplements prescribed by naturopath. I want to see a few more colors on that one. But let's see, let's go to the first one. Medical insurance premiums. Yes, medical insurance premiums that you pay for are medical expenses. I don't know why nobody knows that. So if you have a client and they bring you all their little prescriptions, and you can see from their prescriptions that they're only paying a small portion because the rest of it's covered by insurance, the next question you want to ask them is how much did you pay for your medical insurance? Because that is a medical expense. They might pay on their own. They may have Blue Cross. They may have a private insurance. Get receipts and you can put it on as medical expenses. Or they might pay through their employer. Their employer might put it on the T4, but they might not. If they don't, go get a receipt. Okay, medical insurance premiums, yes. Life insurance premiums, no. Life insurance premiums, you do not get to assist you with your health. You get it after you die. And if you are dead, then it is not beneficial to your health. So, life insurance premiums, no. There might be a different place to claim life insurance, but not as a medical expense. Okay? Everyone gets that one mixed up, so I put it on there. Hearing aids, yes. A cane to aid in walking, I'm going to put an asterisk on that one and say maybe you get it. Not everybody who buys a cane can claim a medical expense. Does anyone know, what do you have to do to claim the cane? You need a prescription. So you'll have to have a prescription. If you have a prescription that says you need a cane, you can claim it. If you don't have a prescription, you can't. You need a doctor's note for that one. Because canes can be costumes, they can be style. People just want to walk around with a cane. You need a prescription for that one. All right, licensed emotional support animal? No. Service animals, depending on the service animal. And again, for a long time, the only service animal that was allowed was if you were blind. Now there are lots of other types of service animals that are required medically, and some of those are allowable, and other ones, specifically like emotional support animals, but some are not. So service animals that are assisting you with monitoring you for epilepsy. There are service animals that will help people who are hearing impaired. It will help people with mobility impairments. Those animals, yes. Emotional support animals, no. There is a list. If you can claim a service animal, so let's go with the easiest one. Say you're visually impaired and you need a service animal to assist you with that. What are all of the expenses that count related to the service animal on your medical expense form? What counts as medical expenses? The cost of the animal, which is expensive, your veterinary bills, and other things, food, care. So again, if you're not sure, look it up on the list. Okay, so licensed support animal, no. Supplements prescribed by a naturopath, no. Treatment provided by a naturopath, look at the medical practitioners list in Manitoba, it's yes. So if your naturopath is administering a treatment and charging you for that, I had a client who had receipts for naturopath. Some of it was intravenous medication that was being given in a supervised fashion. There was a fee for that. That was allowable because it was a treatment from a naturopath. They also paid a lot of money on various supplements. None of those were allowed. So we had to go through those receipts and take out just the allowable amounts and claim those on the return. Okay, eye exam fees, yes, because they're always done by someone who is allowed under the chart. So if you look at the chart, eye exam fees, yes. Gluten-free food products, we've said sometimes you have to have celiacs, you have to have a doctor's note, and you have to have a really, really detailed summary. Wigs for a taxpayer with alopecia. Alopecia is a medical type of hair loss. Yes. I say yes, however, it used to be no. It used to be you could only claim wigs if you had cancer. For a long time, if you had cancer, you could claim your wig as a medical expense. Everybody else who had hair loss from a medical reason, no. Now they've expanded it. If the reason for your hair loss is because of a medical reason and you have a prescription or a doctor's note confirming that, then yes. Medical cannabis, yes, but it's tricky. You have to be required to have it. It has to be from a registered place. And if you're growing your own because you have a license to grow your own, it is the cost of the plants, but not the cost of everything else. Not your electricity for your lamps, not your soil, not your fertilizer. It's just the plant itself. Okay, there are rules. Don't memorize the rules, just know that you can look them up. Acupuncture treatments done in Ontario, yes or no? If they got it done in Ontario and they're a Manitoba resident, yes. What if they got the acupuncture treatment done in Manitoba? Then no. So, acupuncture in Manitoba? No. Acupuncture across the border? Get it done right across the border in Ontario? Yes. Might not be worth the drive because remember you have to pay for the gas, but that's how it works. Okay? A lot of people will ask if you can claim things for medical practitioners from out of the country. Yes, and there is information in the list for how to do that. They have to be equivalent to the same type of accreditation we have here. So you'll have to make sure that they qualify here. If they would similarly qualify here, then yes. And it has to be paid out of pocket. It has to be not covered by insurance and things like that. But there are clients who will go out of Canada and they will go to a place in the States or to a place in another country and they will have surgery done there. They'll have procedures done that can't be done here. If it's medically necessary and they've paid out of pocket, it will still be an allowable medical expense in Canada. It will be audited because it will be expensive. So for those ones, be really careful with your research. Make sure that it qualifies. Make sure there isn't a cosmetic aspect or a voluntary optional aspect to it, because if it's cosmetic, it won't be allowed. That's true for dental procedures. Dental procedures that are medically necessary, which includes braces. Braces are medically necessary because having teeth that aren't straight can affect your health. But things like teeth whitening and veneers probably won't be allowed. Karina, does ticket for the plane include as expenses? We're going to talk about medical travel next. So we'll talk about that, but generally speaking, we're talking about the actual treatment itself. And Brittany, certain medical treatments are not done because they're experimental. Are there any experimental procedures allowed? I would have to look those up on a case-by-case basis. The question really becomes who is doing the treatment, not what is the treatment. Because if the person doing the treatment would not be considered a licensed professional here, if they were going to do things here, then no. But if it's an experimental procedure, maybe there's a doctor in the U.S. that does stem cell treatments that we have not approved here, that probably would be. So when we get into the weeds on those issues, it can get quite detailed. Okay. Medical expenses are audited all the time. All right. We have 10 minutes left. I'm going to push through and get through as much of this as I can so that we have time, because the next chapter is difficult as well. I want to make sure we're hitting our targets. So let's go through some other types of medical expenses. We've talked about the common ones, prescriptions, treatment you pay out of pocket for. There are some specialized categories. Attendant care is one of them. And for attendant care, I'm actually going to recommend, in addition to what you have in your book, spend a little bit of time on the medical expenses list and see what the CRA says about attendant care, because they have a really nice breakdown of what counts and who claims it and how much you can claim and what's allowable, because attendant care will have different rules depending on the level of infirmity that your client has and the type of home or living situation they're in. So you may have someone who is in a nursing home and requires attendant care. The definition of a nursing home, they have 24-hour nursing care, and it is medically necessary. Now, the medically necessary part is easy. There are not a lot of nursing home spaces, so it's very hard to get into a nursing home if you don't need to be there. There are much more people waiting to find a bed in a nursing home. So generally speaking, if your client is in a nursing home, you don't have to worry about whether or not they qualify to be there. You do, however, have to make sure it is a nursing home. Some places, and this is not as common here, but in some provinces, they will have a residential facility that is a portion of it will have 24-hour nursing care, and a portion of it will just have some other assisted living. You'll need to know which kind of unit they're in. Are they in a 24-hour supervised with nursing staff facility, or are they in more of a retirement home with some additional services? So nursing home, they can claim food, accommodation, nursing care, administration fees, maintenance fees, and social programming fees. All of those fees will count as medical expenses. But remember, what happens to your disability tax credit if you claim nursing home fees? So if I have a disability tax credit and I want to put these fees on, what happens? It's gone. And if the disability credit is gone, can I transfer it to someone else? No, because I don't get it. If I don't get it, I can't transfer it. So if you claim all of these fees, no. What could you do if someone's in a nursing home and you want to keep the disability amount? If you can get a breakdown of just the attendant care, so just the nursing care, a breakdown of that, you can claim up to $10,000 and it will be attendant care, and then you can keep your disability amount. Most nursing homes don't give you a breakdown because the fees are so high. All together, accommodation, rent, things like that, all together, it's usually better, so they don't give you a breakdown. You may need to ask for it. And that may be relevant for someone who's only in a nursing home for a portion of the year. So maybe at the end of the year they moved in, and the attendant care would be better because they don't have enough, and the disability tax credit would be important. So you have to look into it. So salaries and wages you can claim if you're in a private home or a retirement home that provides part-time attendant care, or a group home. And then a nursing home, they have a chart. I like the chart. It's great. Use the chart. Expenses you can claim for attendant care, food prep, housekeeping services, laundry services within their personal space. And then salon services if it's included in the monthly fee only. The tricky thing for attendant care is if you pay individual people to do all of these things, it's not attendant care. So if you have a relative and you pay for meal plans and you pay for a housekeeper and you pay for a laundry service, none of that will be attendant care. If you hire one person to do all of those things, it will be attendant care. So individual things, no, but one person who does all of these things, these activities count as attendant care if it's being done by the person who is providing care. Okay? You can't claim rent, food, cleaning supplies, or other operating costs, or salaries paid to administrators, receptionists, groundkeepers. That does not count as attendant care. Then they have the special rule for the disability amount, and they have the chart, and they tell you what documents you need, and all of the stuff is here. So the stuff in the book is good. It is helpful. I like the chart they have on the CRA. I find it helpful. If you find this confusing, go to the CRA, look at this chart. It tells you what type of expense you can claim, what certification you need to get it, and what happens to the disability amount if you get it. It's all in one place on the CRA. They didn't used to have this. It's been confusing enough. They've had enough bad audits that they're putting this information out there now. So attendant care, the taxpayer has to qualify for the disability amount, or if they're in their own home. So if they're not in a nursing home or in an assisted living home, if they're in their own home, they have to be dependent on others because of a mental or physical infirmity. You need a doctor's note. Okay? So disability amount or doctor's note for attendant care, plus all the other rules that you have to think about. 5 minutes left. Let's do medical travel. I think we can get this one done. Medical travel. If you have to travel for medical purposes at least 40 kilometers, you can claim it, but only if you need to go that far to get the help. So if you don't like the doctors who live in your area, too bad for you. You could live with them. That does not count. But if you can't get the medical treatment you need locally and you have to go outside, as long as you go 40 kilometers or more, you can claim the cost of transportation. You have to claim the cost of public transportation first if it's available. So if you need to travel for medical reasons and there is public transit available, that is the cost you're allowed. If it's not available and you need to use your car, then you can claim your mileage with the simplified method the same way we did for moving expenses. Now, in Manitoba, that sounds crazy because we don't have public transportation easily accessible. It basically, if you don't live near Winnipeg or Brandon and you want specialized medical care, you have to drive. So for most of our clients in Manitoba, this is not going to be an issue. On the other hand, you might have a client who lives in sort of somewhere just outside of Toronto, and maybe they don't have something local, but there is the UP Express and there's all kinds of public transit that you could be taking. In that case, you can claim the cost of the public transit because it's available. Okay, so think about your client where they are. I've never seen it be an issue in Manitoba. And again, medical travel is very common in Manitoba because we have a lot of clients who live in communities where they don't even have a local family doctor. So every medical trip they do is a medical travel trip. Okay, if you drive 40 kilometers, then you can claim just the vehicle. That's it. If you drive 80 kilometers or more, you can claim the vehicle expenses plus meals if you ate them using the simplified method or receipts, plus lodging if you had to pay for lodging. If you had to have someone else travel with you, maybe you can't drive yourself to your surgery and then drive yourself home again. If the doctor says that somebody else had to drive you, you can also claim their meals and their lodging. And if it's more than 80 kilometers, you can claim parking. So a lot of people ask me, can I claim hospital parking as a medical expense? No, under any circumstances, unless it is connected to medical travel of 80 kilometers or more, and then yes. Is that fair? Not really. Hospital stuff is very expensive. Hospital parking is very expensive, but that's what it is. Medical travel in Winnipeg, yes, I can. So I had a client. I always had a client who created a problem for me. I had a client who had a seizure disorder and had been to all the specialists available locally. And there was a clinic that was only in Alberta that was an inpatient clinic that essentially you go there and they take you off all your medications while you're hooked up to monitors and wait for you to have a seizure and diagnose you that way. And they were accepted into that clinic, and there was no treatment for them here. They could not get that anywhere other than where they were going. They had to drive to Alberta. They ended up staying in Alberta for, in their case, it was originally supposed to be 5 days, but because they discovered that they knew what was going on, they elected to do surgery, so they stayed for the surgery, and then they had recovery, and then they came back. So they ended up being there for 2 weeks. They had to have a partner drive them because they couldn't drive. Epilepsy, usually you can't get a driver's license. So their partner had to drive them there. They got travel and meals and accommodation for 2 people. The partner had a hotel room while they were staying. They didn't have to pay because they were inpatient, but their partner had hotels and meals. And then on the drive home, they had hotels and meals coming back. And that is allowable because it's not a service they can get somewhere else. Okay. If your trip to the clinic is more than 40 kilometers, again, if you can't get something locally, then we do medical travel, and you're going to take it on a case-by-case basis. If it's necessary, if you could go to a doctor here, you just don't like the doctors here, you like the doctor somewhere else better, no. But if you need to travel, yes. So I very often have clients who live out of the city who drive into Winnipeg, and every time they come to Winnipeg, they see their dentist, their chiropractor, twice a year they see their eye specialist, and they might have a doctor as well monitoring the condition. To prove it, you're going to have a letter from the doctor saying which days you had appointments that you came to and whether or not you needed someone to come with you if you want to be able to claim the extra expenses. So you do have to get that documentation before you claim medical travel. All right. We're going to stop there. We have more to do. I will do more next class, and we'll do the review problems next class. We also have another self-test coming up. Please make sure you've done the self-test as well. So for anyone just logging in right now, we are going to be starting with the final part of Chapter 10, which is medical expenses, covering what we haven't done. Then we're going to take up the review problem and self-test number 4. Then we'll take a break. Then we're going to jump into the next chapter, which is the chapter on seniors. So again, it's going to go relatively quickly today. Hang in there, ask a lot of questions. This is a challenging chapter and it requires a lot of practice. So last class we left off, we had done disability and disability transfers. We did caregiver amounts. We did medical expenses broadly. And we also talked about a number of the medical specific ones, particularly attendant care and medical travel. So the next thing we're going to jump into is renovations or alterations to a dwelling. I'm going to get set up here. Window. And I'm going to share my screen, so you should be able to see in a moment my slides. So just a quick reminder, we're still talking about the medical expenses lines. Medical expenses you can claim for yourself, your spouse, or your minor child on line 33099. Remember to keep the same thing for a dependent who isn't yourself, your spouse, or your minor child on a separate line. Medical expenses are reduced by 3% of your net income if it's for you, yourself, or your spouse, and it's reduced by 3% of your dependent's net income if it's someone else. So you can claim renovations or alterations to your home, to a dwelling, if the person who needs the assistance has some type of mobility impairment or needs to be more mobile or functional within the dwelling. One of the things we run into here with clients all the time is that there may be things that will make their home more functional, but if they substantially improve the value of the house, that will not qualify as a renovation. So some things do not improve the quality of your house. Putting in ramps, putting in stair lifts, putting in that type of thing generally doesn't. On the other hand, some things might. So adding another bathroom on the main floor, that's adding another bathroom to your house, that's substantially going to increase the value of your house, so that will not qualify. Hot tubs are another big one. So hot tubs or tubs with jets may be medically advisable. You may even have a prescription that says you should get one. However, that's going to substantially increase the value of your home, so those things will not count. Can you give me in the chat window, if you're got access to it there, let me know some of the other things that might qualify for the renovation or alterations medical expense. What sorts of renovations would we see for our clients? So Judy, an elevator, again, it would depend on the type of elevator. So if you have $1 million home and you have a very nice elevator, probably not. But on the other hand, there are some lifts that you will use to get, say, a wheelchair or similar things up a set of stairs that would qualify. Lowering countertops is a big one, and very expensive to renovate your kitchen to make it accessible if you need lower countertops. Widening doorways doesn't increase the value of your home. There are other things you might have. You might have assisted alarms and lights to assist someone who has hearing impairment. So if they can't hear the doorbell ring or they can't hear a fire alarm, you may install lights around the home for that purpose. That would be a renovation or alteration to dwelling. These are the sorts of things that we would claim in this case. You have to be careful. You have to deduct any rebates given. So sometimes you'll have an offer, which is if you install this chairlift, it's going to cost you $10,000, but we're going to give you a rebate for $1,000 after the work is done. That rebate has to be deducted. There is no limit to how much you can claim, except for that general, at some point, are you improving the home for other people versus improving the home just for your accessibility needs. So that's the only limit we have to be careful of, and you will need proof. And remember, large expenses tend to get audited. Medical expenses tend to get audited, so make sure you have receipts. Have to claim them when it was paid for. So that's connected to. And remember, if we're doing medical last year, we're doing changing the year that we're claiming medical expenses. We're not using the calendar year. This has to fall within the year that we pick for medical expenses within the dates we pick. Okay. So all of that is allowable as a medical expense. You can also claim moving as a medical expense. So if you remember, there are some circumstances where you might need to move because your home is not accessible for you or not accessible for someone in your family. In that circumstance, unless you moved for a new job, you can't claim medical moving expenses because you haven't moved for new work. And you might be limited because you may move a short distance. So if you can't claim moving as a regular moving expense, you have the option of claiming up to $2,000 of your move as a medical expense. The important thing to remember here is the rules for what you can claim are the same. So anything you could put in a T1M for an allowable expense, you can claim here up to $2,000. You can still do simplified method. If you want to do simplified method, you need the same record keeping. The important thing to remember is you have to have it for a reason. So you're moving to a home that is more accessible for an individual in your family, and you're limited to $2,000. And don't double claim. If you have a choice between a T1M moving expenses or medical expenses, pick one. You can't claim the same expenses twice. Usually, a T1M is more valuable because it's not limited to the $2,000. And remember, medical expenses have to be reduced by 3% of your net income, so you may not get the full $2,000 anyway. So if you have a choice, it's almost always worth it to do a T1M. You'll have to look at each individual case. Are there any questions about those? Those are the basis of the specialized medical expenses. So we're still talking about the medical expenses lines at this point. If you think of any, let me know. We're going to go on to a different credit now. And again, it's very important you remember every new credit we have has different rules, so don't mix them up. Home accessibility. So this is a separate credit. It's claimed on line 31285. It is a federal credit. On this line, you can claim eligible expenses of up to $10,000. It's limited to $10,000. It is expenses incurred to make a home more accessible to seniors or to people with disabilities or infirmities. So home accessibility, you don't have to have a disability or an infirmity. You can also be 65 or older, or be making your home more accessible for a dependent who is 65 or older. Okay? So sometimes you'll have an offer and you'll take that time to get the house ready for a parent who is not needing mobility assistance now, but might in the near future or might in a couple of years. And you have a good deal and you get the work done now. All of those things will still be allowable. So it's going to be the same types of things. It's going to be grips, mobility aids. It's going to be stair lifts. It's going to be extra traction on your stairs so that they're not slippery if you have wooden stairs. All of the types of things that would qualify for the renovations credit will qualify here. You don't have to deduct the rebates if the rebates are reasonable. So it used to be you don't have to deduct the rebates, and then people decided they found a really nice loophole in the tax system, and all of a sudden companies were offering to do a whole bunch of work around your home that would fall under this category, and then they would say, I'm going to charge you $10,000, I'm going to invoice you for $10,000, then I'm going to give you a rebate for $5,000, and then you can take the $10,000 and put it on your tax return. And the government said that's not what we meant when we said rebates were okay. So now it is reasonable rebates. So again, if you have that $10,000 bill and you get a rebate for a portion of it that's reasonable, maybe $500, that would be allowable. You can claim the full amount you paid. You don't have to take the rebate off. But if it's a big rebate, it may not be considered reasonable. And unfortunately, I can't give you a limit there. I wish that I could tell you it's this amount or this percentage, but it's just what is a reasonable rebate versus a scam to try to avoid paying your taxes. So that's the rule for that. The interesting thing that you need to remember with this one is that you can claim both home accessibility expenses and medical renovations on the same return for the same amount of money. So this is one of the few times when you can claim the same amount twice. So think about a scenario where you have renovation costs of $12,000, medical expense, and they qualify. In that case, how much can you claim as a medical expense and how much can you claim as a home accessibility expense? So I have a receipt for a bunch of work done. Maybe I lowered some counters. Maybe I put in a stair lift. The receipt says $12,000 paid out of pocket. What can I put for renovation expenses on the medical expense? What can I put for home accessibility? So remember that the renovation portion is not limited, except I have to take off any rebates, but we didn't have a rebate. So Kendra, you're correct. Home accessibility, I can do $10,000. How much will I do for the renovation? Judy, the total amount for the renovation. So I'm going to get 2 credits. I will get the renovation amount, $12,000 minus 3% of my net income. And I will get another $10,000 federal credit at the same time. Okay, so keep the 2 things separate. You have a receipt in front of you. If you can use it for medical expenses, do. Then you look at it and go, can I use it for home accessibility? There's nothing that says if I've already used it, I can't use it again. Then I'm going to apply the rules for home accessibility. That's one thing that people get mixed up on. So that's what I wanted to clarify. Okay. Some provinces also have a provincial credit. Manitoba does not. But if you're doing a return for someone in a different province, I'm pretty sure, I haven't checked it for this year, but I know in the past Ontario has had a home accessibility provincial credit as well. So if you're doing something for someone across the border, just double check and see what the rules are for the provincial credit in that province. This is one of the few ones in Manitoba we don't have. All right, how do you do it? Well, you have to do a federal worksheet. And the federal worksheet is line 31285. You will have to complete the date of purchase or contract, the supplier's name, their GST or HST registration if they have one. You do get to claim the tax you paid as well, so it's the full price plus the tax. A description of the item and the amount paid, and you are limited to $10,000 per year. You have to claim it in the year that it happened. Okay, so that is everything in the chapter on medical expenses. Remember, there are lots of things that are medical expenses which might qualify or might not. You have to look up the specific rules on the list. If the rules on the list say yes, then yes. If it's not specifically on the list, it is no. There are still lots of things that people pay for that is medically necessary, things that they have prescriptions for that cannot go on a tax return until there has been a change. So this is where lobbying and speaking to our representatives in the government is very helpful. Okay, so we've talked about disability, we've talked about caregiver, we've talked about medical expenses, we've talked about the home accessibility credit. There is one more medical related thing that is not a credit, it's a deduction. So now when we're talking deductions, remember this is going to come off before taxable income. The higher income you're in, the more valuable it is. And if you are being supported by someone and you have employment income, remember that most of the credits that the other person who's supporting you can claim will be reduced by your income. So a deduction will lower your income. So it's valuable for several reasons. Okay. This is available to disabled taxpayers, so you have to have a disability certificate on file. and you have to be working or carrying on research for which you are receiving taxable income. And in those circumstances, one or the other, you can deduct your attendant care against your working income or your research income. So you have to have attendant care. The attendant care has to be there to help you to go to your work or to go do your research. You have to have income to claim it against. You can't go into the negative. You can't claim a loss, but you can claim up to the amount of income you had. There is a complicated formula for determining how much you can deduct. We have very good examples in the textbook. And the form itself, which you're going to do on a form T929, if you do the form very carefully, it also is going to show you how to get the right answer for what you can deduct. There are some limits, but generally speaking, and from a broad strokes perspective, you can deduct your attendant care against your employment or working income. And it does not affect your disability amount. So the nice thing is attendant care as a medical expense will limit how much disability amount you can claim. Or rather, if you claim more attendant care, then you get no disability amount. So we're going to do just a reminder, refresher of what the rule was for that. What is the maximum attendant care you can claim in order to keep your disability credit? Good, 10,000, excellent. If I have attendant care of 11,000 and a disability credit, what is my best option for my medical expenses perspective? Good. Claim 10,000 of it, throw the last bit in the garbage. We're not going to use the extra bit, and keep the disability amount. But before you do that, take a look and see if the disabled client has working income. Because if they do, I could claim potentially the full 11,000 as a disability support deduction, and then keep all of the disability amount. So that would be the best scenario in that case if they qualify, if they have enough income. So again, it's going to feel very messy until you actually practice this and you see some examples and you work your way through your decision tree. Start with deductions if you can get deductions. Then start with your credits. Start with the biggest credit you get, which is usually the disability amount, see if they qualify. Look at caregiver next, and then start working your way into medical expenses. And maximize every decision you make. See if you can maximize what your client is getting. So you're going to claim the disability supports expenses in step 1 of Form T929. In step 2, you calculate the deduction. The rules will be apparent when you use the form. And then whatever's left over, you transfer to line 21500, and it is a deduction. So it reduces your taxable income. So some of these expenses could have been claimed on line 33099. You will have to decide what's most beneficial. Look at the individual situation, not only of the taxpayer, but also of their family if they are being financially supported by another person. You can't transfer the attendant care to a different person. So the only person who can claim the attendant care under disability supports deduction is the disabled person who is working. Because it is tied to their working income, you can't give it to somebody else. That's the only restriction on it, really. And of course, as always, you need receipts for everything. One more. So we've done a deduction now. We've done a whole bunch of different non-refundable credits. There is a refundable medical expense supplement as well. So this one, I will tell you, lots of people forget or don't know that it exists or don't know how to claim it. So if you have a low-income taxpayer and they have medical expenses, you might assume that you shouldn't put any of the medical expenses on the return. Why would you maybe choose not to put expenses on a return for someone with low income? Particularly if you don't know that this exists. Medical expenses are a non-refundable credit. If you have low income, do you need non-refundable credits? Probably not. So a lot of people in that scenario will look at it and go, oh, your medical expenses won't help you, and they won't enter them anywhere. And the client will finish their return and they'll be happy because they got a refund. But if you know that they're low income and they have medical expenses, even if those expenses aren't going to benefit them, you might choose to put them on the return if they will qualify for the refundable credit. So to find out if they will, you need to look at the worksheet, look at the amount for line 45200. There is a maximum claim of $1,285, and it's a refundable credit, so you don't have to have paid any tax or had any tax withheld. You just have to be low income, qualify for this, and apply for it. To get it, you have to be 18 or older, you have to be resident in Canada, and you have to have employment income, or self-employment income will also count, of $3,751 or more. Once you hit $28,446, it starts to reduce how much you get out of the maximum. So it's based on how much your medical expenses were to a maximum claim of $1,285. And then if your income goes over $28,446, you start to reduce it by 5% of the income that was over that. And if that calculation sounds complicated, just put the numbers in the worksheet and you'll get the right answer. This is one where you can actually get a lot of money for clients if they didn't know all of the specific details. So I had a client who came in. We do a thing at H&R Block called Second Look. A second look is they come in, there's no fee for it. It's completely free. They've already done their tax return, but they weren't sure about something on their tax return and they want a specialist to look it over. So this client came to me, I did a second look for them, and I realized that they had a bunch of medical expenses that they hadn't claimed. In this case, what they didn't know is that they could claim medical travel. They were in a small area that didn't have any local medical services. And I asked them, did you have any medical appointments last year? And it turns out they had quite a few. In fact, they had to drive into Winnipeg, and it was more than 80 kilometers every time, an average of 4 or 5 times a month, because they had a lot of different specialists that they were seeing. So we were able to get medical travel documentation from all of their doctors saying these are the dates they appeared on their appointments, and these are the ones they had to have someone in the car with them for. And we were able to figure out how many meals they'd eaten because it was a full day trip there and back. And then I realized that when you put that together with their other medical expenses and their income, we could also get refundable medical expense supplement. So we improved their refund from the medical travel, which was only a little bit beneficial for them on the surface of it because they were fairly low income. But then all of those medical travel expenses added into their refundable medical expense supplement. We then went back and did the previous 7 years where they had the same things, and we could get documentation for all of it. And they got really good refunds when the adjustments went through. So it was a very, very big difference for that client. They are now a regular client of mine. They come in every year to see me, and they do their return. So knowing your medical expenses, you're going to see you have a lot of options to improve refunds for your clients, but you need to know the details. So take a little bit of time. After next chapter, the one we're going to start on today, when we finish that one, it gets a little bit easier to the end of the course. So you're going to have a little extra study time to review this chapter. I would say this is one of the most important, complicated chapters in terms of immediately finding better answers for your clients than they would do on their own. Okay, and just a quick refresher. If you have attendant care, what can you do with it? This chart is in your book. The other place you're going to find a chart related to this that is incredibly useful is the CRA website. If you remember last class, I showed you on the CRA website where you say list of eligible medical expenses. If you click on the details for attendant care, the CRA has their own really useful breakdown that will tell you what qualifies for attendant care, what documentation or certification do you need to get it, and what happens to the disability amount if you claim it. Just a refresher, if you have attendant care and you qualify for disability support, You can claim your attendant care with no limitations and keep your disability amount. If you're going to claim it on line 33099, you can claim up to $10,000 and keep your disability amount. If you claim more than $10,000, you lose your disability amount. And if you claim any medical expenses from a nursing home, in addition to attendant care, you lose your disability amount. So if it's a nursing home and it's a lump sum, there's no breakdown on the receipt, any dollar of that you claim, you're going to lose your disability amount. But if you can get a breakdown and take just the attendant care portion out, you can claim up to $10,000 of the attendant care and keep your disability amount. So lots of options for the same single receipt you have sitting in front of you. All right, got one more slide for you. I'm going to mention it really quickly because it never applies. So there is a mention in the book of the gasoline excise tax rebate. It is a rebate you apply for separately from the tax return. There is a form called a Form XE8. Very rare that this will apply. It is available to taxpayers who are medically certified as suffering from permanent mobility impairments to the extent that it's unsafe for them to use public transit. To get this, they have to live in a place where there is public transit that they can't use. So most of the time, they either don't have public transit, so they don't get this, or they have public transit, but that public transit has an additional service. So it might have a handy trans, it might have some other public service that makes it safer for them to use. So if you have a client who falls with this very, very narrow restriction, just remember there's a special rule and look it up. I will tell you I haven't found one yet because we have services in Winnipeg that make it possible for them to use public transit in a different form, even if they can't use our regular bus system here. Okay, so medical expenses federally is complicated. The problem we're going to hit next is provincially. It's a whole other ballgame in Manitoba. So I'm going to spend a little bit of time now. I want to talk about provincial medical related credits on the tax return. This I'm going to recommend you spend a little bit of time with your provincial supplement and see if you can organize for yourself what qualifies and what doesn't. The problem we have in Manitoba is most provinces, the medical related things on the provincial forms are an exact mirror of the federal ones. So if it's on the federal one, the rules will be the same on the provincial one. Manitoba, that is not the case. We have a different set of rules for many, many of the credits on here, and we have more refundable credits that are quite different. I wish that I could tell you that because they're provincial, they're not that important. The problem is these are very common. So we see them all the time, and we have to be able to deal with them if we're doing returns in this province. So I'm going to spend a little bit of time now going into my provincial supplements and going through the book with you. You're not going to find this in your textbook anywhere, but you will have the recording to help you review it as well. So I'm going to start at the top with our non-refundable tax credits. And if you've looked at this from before, we went through this, many of the things that are federal will be mirrored on the provincial. So generally speaking, there will be a disability amount. If there's a federal disability amount, you will automatically qualify for the provincial disability amount. If you qualify for a transfer from a spouse for disability, you will have the same type of form, different numbers on it, but you're going to have an MB Schedule 2, an MBS2 to do the disability transfer from your spouse. The same rules apply. If you're going to do a dependent transfer from a different dependent who's not your spouse, it's going to work just like the federal one. Calculate how much they need provincially first. Anything left over can be transferred to you. If you qualify federally, you qualify provincially. That's the same. What's different is the caregiver amount. There is a provincial caregiver amount, but it works a little bit differently. So the rules for who qualifies for a caregiver amount will be the same. They have to be infirm. They have to be dependent on you for support. But you're going to notice that there are some differences. The first one, there is no caregiver amount for a spouse provincially. Federally, remember, caregiver amounts are added to a spousal amount, or you have the option of claiming a caregiver amount for the top-up. Depending on your income, there may be a top-up for a spouse as well. Provincially, there is no caregiver amount at all for a spouse. So that is very different. There is also no caregiver amount for infirm children under 18. So if you have a child under 18, you will get a federal caregiver amount for that child. You will not get a provincial caregiver amount for that child. Two big differences. There is a new credit as well, which we're going to talk about when we get to it, which is the amount for infirm dependents. Completely different credit. The rules will be different for that one as well. So we have to look at that one. And you'll notice Manitoba doesn't have a home accessibility expense line. All right, amount for infirm dependents. We think, well, that's great. We don't have a caregiver amount for spouse, but they could be an infirm dependent age 18 or older. The problem is the people who qualify for this credit have to be child, grandchild, parent, grandparent, brother, sister, sibling, aunt, uncle, niece, nephew. Spouse is not on the list. So you still don't get it. And they have to be 18 or older, so you're not going to get it for your minor children. And then they have additional rules. So in order to claim it, to get the amount for infirm dependents age 18 or older, they have to be dependent on you financially. They have to be one of the people on that list. They have to be over 18, resident of Canada at any time in the year, not necessarily the whole year, but at some point in the year they have to be resident of Canada. And the way that this one works is you're going to use your worksheet for Manitoba. You're going to do the number of dependents who qualify for this. You start with the base amount, subtract their net income, so it's tied to income. If they have income over $8,720, you're not likely to get anything. Okay. Then you can find out how much they get to the maximum, which is $3,605. You can split this with another person, but you can't claim more than the max. You can have more than one dependent who qualifies, but again, only the ones on this list, and they have to be over 18. So as you're going down your federal form and you've sorted out all your dependent things and you've made all your decisions for what qualifies, you get to the provincial one, you have to start the process again. You're going to match anything you can match. You're going to eliminate anything that has to be eliminated, and then you're going to remember that there's also this one. And you're going to think about it again and say, do I have anyone who qualifies provincially for the amount for infirm dependent, age 18 or older? Okay, so credits, a little bit complicated. Caregiver, remember I said the rules are different. If you're doing a caregiver amount provincially, come back to your supplement and look at this page. To get a caregiver amount provincially, they have to be you or your spouse's child or grandchild, parent, grandparent, brother, sister, sibling, niece, nephew, aunt, uncle. If they're not on that list, you do not get a caregiver amount for them provincially. You might get one federally. You don't get one provincially. Dependent has to be 18 or older. So that's different. No child caregiver amount. They have to have a net income on that line, or the amount it would be if they filed a return of $15,917 or less, so it is tied to their income. They have to be dependent on you because of an impairment in physical or mental functions. There are some rules if they're being supported by another person, so you'll have to look at the rules for that. And then you're going to figure out how many claims you have. Put their base income in. It has to be below that amount. The maximum claim is $3,605. And if you want to split this with another person, you can, but you can't go over the maximum for each person. So again, when you get to caregiver on a provincial one, stop. Don't think about what happened federally. Take a look at your dependents and start the rules again provincially. Okay. I'm going to remind you on the Manitoba Family Tax Benefit, there are some lines in here you can fill in now because you know if you have a disability. So if your spouse has a disability, you're going to change that. Disability means disability certificate on file. If you're claiming a disability transfer from someone who isn't your spouse, you get another claim there. Every disabled dependent 18 or older you have a claim for, and every dependent child under 18 you have a claim for. So now you can fill in the dependent section of your MB 428A. Not done yet. There's a few more. Going to go down and we're going to find primary caregiver tax credit. This is a very, very unique refundable credit. In all the provinces I've done returns in, it's the only one I have found where there is no requirement to be related to a person and there's no requirement to be financially supporting them. So everything I said at the beginning of the chapter on dependents, dependents have to be financially supported by, they have to usually be a relative. Throw that out the window when you get to primary caregiver tax credit. Completely new, very, very different. It is a refundable credit of $1,400 per year for anyone who is providing voluntary unpaid care for a family member, friend, or neighbor who is disabled. So, doesn't have to be related to you in any way, just has to be someone you're voluntarily caring for. And in this case, the definition of caring for is different because it doesn't have to have a financial component. So, the person you can receive it for has to be living in a private dwelling in Manitoba. They have to be living in a private home. The purpose of the credit is to assist people to stay home longer, which means if you're helping someone to stay in their home, there is a refundable credit for you that you can apply for. Okay. They have to have a level of care 2, 3, or 4 requirements. If you want to know what those are, you can look at the form. If you search Primary Caregiver Manitoba, you can see the application form, and it has very specific information on there. We don't determine who qualifies for it, just like a disability certificate. We don't determine who qualifies, but we might identify a family member based on what they tell us in a client interview who might not know about it, who could apply. So if you have a client and they're talking about a dependent and then they're telling you all the things that they're doing to help someone and how much time they're spending volunteering, you might go, oh, that sounds like something that would apply for this. Give them the information, the application, and then they can get that filled out themselves. The people who work in the provincial department that deal with primary caregiver tax credit are generally pretty helpful. I know phone times have not been good since the pandemic, but generally they're able to assist clients who have questions. All right, so the person receiving care needs assistance with at least 3 of the following categories because of a physical, cognitive, or behavioral barrier. And again, notice it's not financial. It's help with shopping, meal prep, laundry, transportation, driving them places, supervision with personal care tasks, bathing, eating, grooming, hygiene, dressing, medication, arranging for supports like community access, recreational activity support groups, counseling, medical appointments. So if you're taking someone to medical appointments and helping them keep track of their medical instructions, or requiring regular and sustained advice, assistance in decision-making, or emotional support. So 3 of the following categories, and you're doing all of those things. If you do them for 90 days in the year, then you qualify for the credit. Less than 90 days, you don't. So this is different. If you've seen this credit in the past, it used to be that you had to do 90 days and then there would be a prorating depending on how many days in the year you did, whether you get the full amount or a smaller amount. You had to keep logbooks. You had to apply in advance before you claimed the credit. It was much more difficult for clients to access. They have recently changed the rules. So now you don't have to apply in advance. You can put it on the return right away as long as the application makes it to the department before the deadline for the tax return. So for this course, the deadline for your tax returns will be April 30th. You can put it on the return in February, in March, and they can file the application after. It doesn't have to be pre-approved. Okay? They must be resident. They have to provide care for 90 days. There's no proration anymore. So now, 90 days, you get the full amount. Less than 90 days, you get 0. And that's it. Okay? 1 claim per taxpayer. So you get $1,400 a year as a taxpayer. Any questions about that one? It's a very valuable credit, and we see it frequently. There's a few fussy rules in here. So, for example, if your spouse is being paid to be a carer and you are assisting them voluntarily, it won't count because it is your spouse's job to do the work and they're being paid for that. So a few little things in there. And other than that, lots and lots of people in Manitoba qualify for this. They have to apply. What proof would they need if they were audited for this? Two things. So you have a client who put it on the return, they got $1,400 from the provincial government, and now they have a request for info saying we want supporting documentation. What supporting documentation would they need? I know it's early and I've talked a lot. The answer to this question is worth $1,400 for our clients. So Kendra, receipts are problematic for this one, although there may be receipts that show that they are financially supporting them as well. But remember, most of these things don't have a financial component. They're a volunteer component. So they'll probably need some type of medical letter saying that they require assistance. They'll need the application. So you'll need a copy of the application that they sent in. And some type of logs or a breakdown of how they came to the 90 days. What did they do for 90 days? Again, under the old system, they had to keep a logbook all year. So every time they would do one of these things, they had to keep a logbook. That was unsustainable. So you don't need to keep a logbook for the whole year, but you're going to have to be able to give some kind of evidence that you have done tasks that fall under the category. So that might be you'll have a record of all the medical expenses that you took them to, medical appointments you took them to. You'll have a regular schedule where, twice a week you go over and you assist with various tasks and you do meal prepping for them, something to show a log of this is how much time I'm spending. And that's it. So it's actually fairly easy to prove once you have the application filled out. One more. We're not done. Manitoba has a lot. So in Manitoba, you can claim as a medical expense some fertility treatments, depending on what's on the list. Federally and provincially, the rules will be the same. If you have fertility-related medical expenses on your return, you should also be thinking about the fertility treatment tax credit. And Judy, if you only did shopping and laundry, would you qualify? So you have to have three things that fall under three categories here. So you would need shopping and laundry and two of the other categories. So what are the other things that you are doing? But most of the time, if you're doing it for 90 days for a person, then you can probably also include some supervision or some supports or some sustained advice. So it's not hard for most people based on what you do for people who meet the impairment requirement. It's rare that you would be assisting them in only one of the categories and not doing other things. So if you're doing shopping and laundry, you're probably also driving them to counseling and medical appointments, and you're probably also giving them some assistance in decision-making and emotional supports. So it becomes very easy to qualify for the three categories, just from a practical standpoint. So shopping, meal prep, laundry, transportation is all one category. And then take a look at your day and go, did I do any of the other things in the year? And if you did, you probably qualify. So fertility tax, again, I want you to think of this separately from the rules for what qualifies for medical expense because they are different. But if you have a medical expense for fertility treatments, take a look at the same receipts and ask yourself, can I claim a refundable provincial credit for them. It is available for Manitoba residents who are receiving fertility treatment. You get 40% of the treatment cost to a max of $20,000 of treatment. So the credit could be worth $8,000 per year per family. Okay. What you get is fertility treatment costs paid to a clinic in Manitoba. So the first rule you have to remember is you might get fertility treatment anywhere in the country that will qualify as a medical expense as a Manitoba resident. To get the refundable one, you have to get treatment here, and the prescriptions have to be written from here. So costs for treatment that happened in Manitoba, prescriptions that were issued in Manitoba. The expenses are on the list here, all of the things that you usually need, including any prescriptions to support those things. What don't count are anything reimbursed, so if it's covered by insurance or partially covered by insurance, it's only the part you paid out of pocket. You can't receive any treatment prescribed outside Manitoba. You can't claim travel or board and lodging to get the treatment. You might qualify for medical travel as a medical expense related to fertility treatment. If you can't get fertility treatment in your local area and you have to drive to Winnipeg to get it, it'll be a medical expense, but it won't be included as the refundable portion. Okay? And you can't claim it for reversing a procedure that you had previously to prevent fertility. So if you had a vasectomy or a tubal ligation in the past and now you want to reverse it, that does not count as a fertility treatment. But everything else, in order to help yourself to become pregnant or your partner to become pregnant, that would count. Okay? Up to $20,000, and you'll notice there's nothing that says you can't claim it as a medical expense and as a fertility treatment. This is one of those other rare scenarios where you can put the same receipt in two places. Okay? So that's another important one. If you're noticing as you're going through the medical receipts that you're seeing things from a fertility clinic in Manitoba, a light bulb should go off in your head, and you're going to grab your provincial supplements book and look up the rules for fertility treatments in Manitoba. All right, that's medical expenses. We did it. It only took an extra hour longer than it does for people in other provinces, but we did it. So I would like to do, before we take our break, because I think I can do it quickly, I would like to do the case that we had for this class. I'm going to do the federal part fairly quickly because there's not a lot of new stuff. I'll do the medical things, but everything else I'm going to go over very quickly because I want to spend a little bit of time talking about the provincial side because the provincial side is more difficult. So let me find my case here. You can find yours. Get your answers ready if you have them done. I want you to notice at this point in the course, you are no longer being asked to do complete tax returns. So if you don't have time to do a complete tax return, you don't have to. Just do enough of the tax return to get the answers to the questions that you need. If you want to do a complete tax return, I'm never going to say don't practice tax returns. Absolutely do. I will say I'm not going to spend as much detail on the end of the return or the details other than the questions. So if you're not getting the answer that you want to get and it's going too fast in the recording, send me your fillable forms. I will look at anything you worked on and correct anything you've done. So you'll still get the full answers, but for those of you who are saying I have too much studying and these cases are getting really long, read the instructions very carefully. You might be doing more work than you need to be doing. I do recommend any case that has medical expenses, if you get a chance, try the provincial ones as well because they're difficult in Manitoba. And again, I will spend a little bit of time showing you the Manitoba side of your medical expenses because we need more practice. All right, we have Adam and Gail East. They lived at the same address. He works as a veterinarian. He received $40 for serving on jury duty. Is jury duty reportable and taxable? What do we think? Yes, it is. Excellent. I did not expect anyone to remember that off the top of their head. I don't remember that one, and I teach this course every year. If you're not sure and you see something and you don't know if it's taxable, you can search for it. So if I type in the word jury, because I'm looking for anything related to jury duty, it's going to give me a chapter 6 that tells me jury duty is taxable. It goes on line 13000 as other income, and I go, oh, good, because I wasn't going to remember that on my own. And then I go back to the case, circle it, write the line number. That's where it's going to go. The two that I get mixed up in my head because I don't see them very often and I don't deal with them all the time. I know jury duty and strike pay have special rules, and every time I see strike pay, I look it up. Every time I see jury duty, I look it up. Off the top of my head, I'm pretty sure strike pay isn't taxable and jury duty is, but I wouldn't trust my instincts. I would look those ones up every time. All right, he also has a savings account at the Royal Bank and a T5 slip from the Bank of Canada. We have receipts for those. When you see receipts for a T5 with one person's name on it, what questions should you ask your client right away? Doing a little refresher from Chapter 7. I have a married couple sitting in front of me, and I have a bank account, and I have a T5 slip. What questions should I ask? Is it a joint account is a useful question. You can get to the answer even faster if you ask who put the money in the account. Because even if it's not a joint account, remember they're married, attribution rules might apply. But joint account is a good place to start. So is it a joint account? Yes or no? How much did you each put into it? If it's not a joint account, who put the money in it? Is this all your money, or is part of this somebody else's money? Because remember, Gail was injured in an accident. Gail has no income now, but it's possible that Gail had a large portion of income resulting from the accident, whether that was compensation, there may have been something taxable there, a lump sum might have gone somewhere, so we still need to find out whose money it was originally. Good question to ask. I will tell you, for the purposes of the case, this is Adam's account. He puts the money in it from his employment. All right, so he has some interest income. We're going to have to put that on the return somewhere. Gail has a disability on file. We should also be checking to see, because we know that Gail's income will be low, whether or not Adam has on his record the transfer. So is he eligible to receive a transfer of the disability credit? If he isn't, what should we do on the return this year? So if he is not eligible to receive the transfer because he hasn't asked to, how should we do his return this year? If I claim the transfer for the first time on the return and he's never claimed it before, what will happen to his return? Will they process it right away, or will they hold on to it? They will hold on to it. So if I don't want them to hold on to it because maybe he needs it for reasons, file without, and then file an adjustment and ask them to add it. Now, I will tell you a small secret. If it is early in the tax year and you can get through to a helpful agent and their spouses who live together, there's a small chance, it's not every time, but if you want to sit on hold, give them a call. If the agent sees that they're married and they're living together, they have the discretion of updating the information and allowing the transfer right away. It takes about 3 weeks to process on the CRA side of things, but they might do it without you having to file anything. Try it first. If it works, then you might have a 3-week delay before you can file the return with the transfer on it now, which is your best case scenario. But the answer very often might be no, you have to file an adjustment. And it depends on who you get and how busy they are and just how helpful they are. So I always, with spouses, try it at least once. See if they will do it, because if they'll tell you, yes, I'm updating your file now, you should see it posted in a couple of weeks, then you just check your account every week or so. Once it gets there, you can go ahead. Otherwise, adjustments are going to take a long time. File without it, file an adjustment. Once it's on there, we can continue. All right, so in this case, she has been disabled for a long time. She's had low income for a long time. Adam has been her spouse with the primary income. You can pretty much assume he already has it. Check anyway, but I would expect in this case that the transfer is already on file. All right, now we have some medical expenses. So on this list of medical expenses, I have dental work from 2019. Can I put a receipt for 2019 anywhere on a 2021 tax return? Nope. There's no way for me to make that in a calendar year that ends in 2021. So what do I do with the receipt? Well, I can throw it away. Before I throw it away, I'm going to look at their 2019 and 2020 tax returns and see, did they claim other medical expenses? Maybe they missed one and I can do an adjustment to get them a bit more. Or if I look into them, I might see that they just didn't have enough medical expenses that year, in which case I'm going to tell them, you can throw this out now, you can't use it. But check first, because maybe in 2019 they filed a tax return with a lot of medical expenses and they missed this one and it's $530, so you can get them a bit more. All right, so we've ruled the first one out. Now I have some choices to make. What date or dates? There's a variety, but what date or dates would you recommend the end of your medical tax year to be? So what is the last medical receipt date that you're going to put on a return? So Lee is recommending September to September, sorry. So yes, you absolutely could do September 2nd of 2020 to September 1st. You could do September 9th to September 8th. Either one is a good choice. The decision between them might be dependent on your insurance in this case. So they do pay for Blue Cross private insurance. I might want to see what dates they pay for their private insurance, because if it's the 1st of the month or the 5th of the month, that might influence my decision. But I definitely want to get September 1st in there, because September 1st, that's a good medical expense. And if I can, I want to get to $785. So that is a good choice, and we're going to look at those dates. What's going to happen with the October 9th receipt, which I'm not going to be able to claim because it's outside of our calendar year that we're or outside of our medical year? I'm going to save it for next year. Good. So medical expenses will be $785, $370, $60, and $320. And then we hit the bottom ones here, which are complicated. Now, this case was not quite like real life. So he pays $230 per month flat rate for his entire life. That's what he pays, which is nice but not realistic. So assuming that his medical premiums have not changed in the last couple of years, how many months of medical premiums will I be able to claim? If I'm doing a medical date, September to September, I can claim 12. That might have changed your numbers on the return. If you did, you are correct. You have to look at what it is for this year, but don't forget, we didn't claim any medical expenses last year, and he paid medical premiums last year, so I can claim those months. So depending on the dates, I'm going to be doing premiums for September 2020 to August 2021, or I might be doing October 2020 to September 2021. Got to figure out from the pay stubs or from the Blue Cross receipts what days they pay their insurance on, claim the full months. In real life, we need a breakdown because in real life, premiums change throughout the year. So they can change every quarter, they can change every 6 months, but they're very rarely the same every single year. So you do have to drill down and find out not just what you're paying now, but what you paid in each of the months. Okay? So if you didn't get that one right, I would say that's a failure of the case to not be specific. Ongoing, if you're doing this and you hit something like that and you don't have a quick answer and it's going to change all the numbers on your tax return, you can always email your client and ask your client for clarification. Just send me an email and say, hi, Dr. West or Dr. East. I have a question for you about your medical premiums, and I will pretend to be Dr. East and I will answer your questions. All right, so we're going to do insurance for 12 months because we're going to match the medical year that we're doing. It won't be January, December. It'll be September to August or October to September. Then we're going to do the stair lift. So I can claim the stair lift as a medical expense. If there is a rebate, what do I have to do? Medical expense, rebate, Judy, I'll answer your question in a minute. I have to reduce it by the rebate. So in this case, there isn't one, but always ask. What else can I do with the stair lift? So I'm going to put it on as a medical expense. What else can I do with the stair lift? Completely different line on the tax return. What am I looking for? Home accessibility amount. Good. If there was a small rebate for the home accessibility amount, what would I have to do? Let's say there was a $50 rebate. Home accessibility, deduct it or don't deduct it. I do nothing. Good. So just checking. We just learned it. Just reinforcing. All right, Judy, you had a really good question, which is if you pay Blue Cross premiums, can the premiums be used? Yes. So if you pay Blue Cross medical insurance, premiums are a medical expense because you pay them out of pocket. Similarly, because this is the one everybody forgets, so I know I said it before, but I'm going to highlight it. Medical travel insurance is a medical expense. So travel insurance, if you're buying travel insurance because you're going to a different country, keep your receipts. It's a medical expense. They're small sometimes. They're getting more expensive right now, but it's one that a lot of people do. So if your clients went on vacation and they tell you where they went on vacation and you're doing medical expenses because they have a bunch of them, ask them if they bought travel insurance. Get the receipt for that added in. All right, so we're going to do the home accessibility amount and we're going to do the medical expenses. The stair lift will be both. We have some donations, Salvation Army, Heart and Stroke. Don't forget, on the T4, there can be more donations. There's $57. If you missed that, your numbers are going to be off by a little bit. What other deductions can he claim? So we are going to have a T4. What are the deductions from his T4? We have union dues. Excellent. What about the box 20? Box 20 is retirement pension plan, RPP. So we'll have a deduction for RPP. And we'll have the enhanced CPP portion. So those are all deductions. Gail has a disability benefit. So remember, if we're doing a spousal amount, which we will be doing, it has to be reduced by her disability benefit. Right. So we talked about jury duty. Jury duty was, I think, $40. It goes on line 13000. What line number does the Royal Bank interest go on the tax return? 12100. Excellent. And you need a federal worksheet for it. Canadian saving bonds interest, same thing. How should he report the amount in box 40 of his T4? This is a refresher to the first class. I'm just going to tell you the answer. Box 40 is already included in box 14. You don't need to put it on the return. It's already in the amount on line 10100. What amounts can he deduct? We said that already. So you have RPP, you have union dues, you have the enhanced portion of the CPP. What is his net income? I'll show you that on the tax return. What personal amounts can he claim? I'll show you that on the tax return. Who should claim the medical expenses and the charitable donations? So be careful. You can get the right answer for the wrong reason. I want to see if we can get the right answer for the right reason. General rule is lower income should claim medical expenses. However, in this specific scenario, should Gail claim medical expenses and or donations? And if not, why not? What is her income? Good. It's not enough. Her income is below her personal credit. She cannot use a non-refundable credit. So you could say Adam should claim it. If you said Adam should claim it, it is the right answer. But if you said he should claim it because he has the higher income, that is the wrong answer. He should claim it because even though he has the higher income, and medical expenses should be claimed by the lower income, she can't use them. So we're going to give it to the only person who can. And that, I know, is really pedantic, but it is going to make sure you're making good decisions for your client. We get into the habit that you give all your credits to the higher income person. Sometimes that's not the best solution. So I want you to make sure you're thinking about it for the right reasons. Good. What's the amount of the donations tax credit? I will show you that. Should they claim them this year? What option do they have? Remember, they had some big medical expenses that they're not going to have next year. So we're expecting he's got deductions, he's got disability transfers, he's got medical expenses, going to have a refund this year. Maybe save it for next year. Thank you, Kendra. Good. So you have the choice. You can put it on if they want it. You can tell them how much they're going to get for it. But maybe if they're donating again this year, it'll be more beneficial if they want a bigger refund next year to save them. I will tell you, only do this if your clients are organized. We don't keep medical or donation receipts in our files. Clients have to save them. If your client is going to lose it between now and next year, just put it on this year. Because it's better for them to do it and have it in their tax folder, which they probably won't lose, than for them to stick it in their pocket and try to remember to bring it back next year. So you'll get to know your clients. You'll know which ones are the organized ones and which ones need a little bit more assistance from us. All right, we've done the medical expenses that should be claimed. I'll show you that again. I'm going to calculate the medical expenses for you. Should they claim the home accessibility expense? We did that. Who should claim it? It's a non-refundable credit. Adam's the only one who can use a non-refundable credit in this year. Okay, we're going to complete the schedule for that, and I will show you that. Do we think he's going to get a refund or balance owing? Lots of credits, lots of deductions. Not very much extra income. There is some extra income, but not a lot. A little bit of interest and some jury duty. I'm expecting not just a refund, a good refund this year. So let's see if we got one. Okay, Adam. And we did. So if you got to this number, congratulations. It is difficult to get to because of the provincial side of things. If you didn't get this far because you didn't have to have a refund, you just need to know he was going to get one, that's also fine. But let's go back to the top of the return and see what we did. So we have income at the top. We have his interest income here. We have his jury duty here. Total income, $83,778. Deductions, registered pension plan, union dues, enhanced portion. You still need a Schedule 8 for that. Net income is $81,239.50. That was one of the questions that we had to answer. And it's also his taxable income. He's in the second bracket. I know I'm going really fast through this. There will be a recording, so you can pause the recording and get the numbers. Even better, send me your forms, and I'll check them for you. All right. Personal credits. He gets his personal amount. Don't forget, when you're asking a question about what personal credits you get, we're talking about everything in the first part of Part B, and that includes the basic one that everybody gets, so don't leave it off a list. Then we're going to do a spousal amount. When we do the spousal amount, what will we add to it? So he has a spouse who has a disability, who he is supporting. What additional credit will we add to the spousal amount? Think federal credits. Think about the medical chapter. What do we have for people who care for people who have disabilities? Caregiver amount. So we're going to add the caregiver amount. So we're going to put $13,808 plus the caregiver amount. The spousal caregiver amount is included in the spousal amount, so they go together. And then we're going to reduce it by her net income. In this case, based on her net income, do we need to worry about a top-up to the caregiver amount? Remember, if you have an elder dependent or you have a spouse with a caregiver amount, sometimes there's a top-up to that. Will it apply in this case? No. Because her income is below roughly $7,000. In my head, I know it's somewhere between 7 and 20 something, but over 7, I go look for the top up. If you were to look for the top up, you get down to the bottom and you would see that the top up is, there you go. Nope, it's up further. The top up is 304. They keep changing my forms on me. So spousal amount, elder dependent amount for elder dependent, caregiver, top up. Yep, 7,000 to 24. So income between there, we're doing a top up. Okay. So we have personal amounts. Will be 3 of them. He has a personal amount, he has a spousal amount, and a caregiver for his spouse. He has it, it's included in the spousal amount. Make sure you mention all 3 of them if you're answering the question. Right, back to credits. Also gets CPP, he gets EI, he gets the Canada Employment Amount. Home accessibility expenses, if we want to do that, we need a worksheet. And it's going to look like this. You should practice filling it in if you haven't. It's good to do this one at least once. You need the date of the sales slip or the contract, the name, GST, the description, the amount that you paid. You have to have paid for it. If it's something you owe, you're not going to be allowed it until it's paid for, unfortunately. So make sure you have one that says that it's paid. Put whatever's smaller, that number, or 10,000. That number is what we're going to do. We're not splitting it with anyone. So we're going to claim the 2,900. We could split it with Gail if we wanted to, but she can't use it. It's a non-refundable credit. Okay. Back to the credits. Then we're going to get 2 amounts transferred from a spouse. Disability is the only one we can transfer right now because it's the only one I've taught you. You need a Schedule 2. Schedule 2, you're going to add anything from these lines. The only one we have is the disability amount. Then we need to know how much of it Gail needs on her return. So we're going to put her income, and then we're going to look at her credits. And her credit, just the base amount, is enough to wipe out any need for any additional non-refundable credits. So Gail needs to use 0, which means the amount available to transfer is all of it being 8662. That goes back onto Adams. So that is a very important one to do if you're doing a transfer from a spouse. If you're doing a transfer from a different dependent, make sure you do the same thing on the worksheet. You can't automatically transfer all of it unless their income is low. All right, then we hit medical expenses. If you got 7,135 for your medical expenses, congratulations. How did I get that number? I have the dental, the prescription drugs, the eyewear, Blue Cross insurance, 12 months of it because it was the same this year and last year. In real life, it was different, but let's make the case a little bit easier. And the stair lift. We've already claimed the stair lift once. We're going to claim it again. So there's the 7,135. It's going to go on the correct line. This is very important. I cannot stress it enough. Anything for yourself, your spouse, or your dependent children goes on line 33099. If he was claiming a stair lift for someone who wasn't Gail, that he paid for, it would be on 33199, and we'd need to reduce it by 3% of their net income. But this one, we're going to reduce by his net income. 3% of his net income is more than the max, so we're just going to reduce it by the max. That leaves $4,714 available. Donations and gifts, if you've done your Schedule 9, you should get $104.53 of additional credits. Going to bring his federal tax down to 6973.5, and I'm going to spend a little bit of time showing you the provincial ones. So I'm going to do the provincial ones, following them through. Notice he gets the basic personal amount for him. Notice for the spousal amount, there's no additional caregiver portion. So for the spouse, there's no caregiver amount. It's just spousal reduced by her income. I want you to notice as well, she's not an infirm dependent age 18 or older because she's a spouse. She's not on the list for that one. You're going to get CPP. You're going to get EI. Going to keep going down. I want you to notice there's no caregiver amount here either. Caregiver amount for provincial has its own rules, and she's not on the list again. So caregiver amount for spouses, caregiver amount for children under 18 do not exist provincially. Okay, Disability amount transfer from a dependent would go here. She's not a dependent, she's a spouse. So we're going to do on the bottom section where the spouse is, and if you find these forms hard to follow, they're not well organized in Manitoba because we have a lot of things. So just keep going line by line so you don't miss any. We have disability from a spouse. It's going to look the same. You'll have $6,180. We're going to do her income, find out how much of it she needs. She doesn't need any, but remember, if her income had been a little bit higher, she would have needed to use some of her provincial credits, so we can't transfer the full amount. In this case, her income is so low, we can transfer the full disability amount. Complete the Schedule 2, back onto the form. Total credits, $23,672.49. Then we're going to do medical expenses. We're going to match what was on the federal return. Whatever was on the federal return, the same number will go here, 7135, reduced by the percentage of his net income or the max. The max provincially is 1728, so he's going to get a little bit more provincially, and that gives 5407. And the donations, if we did them federally, we're going to do them provincially as well. So his Manitoba non-refundable tax credits are $3,206.90. I want you to notice provincially, no home accessibility amount. Federally, we can claim it twice. Provincially, the stair lift is just the medical expense. Okay, and that brings the tax owing provincially down to $6,882.02. If you did a family tax benefit, I recommend it. Although his income is high, you're going to notice that with some of the extra things, he's getting closer to being able to claim one. So he has a claim for himself, a claim for his dependent spouse, because he had a dependent spouse, and a claim for the disability amount from his spouse, because that was transferred to him. So all of that together was $6,882. Still not quite enough, but if he'd had just a little bit less income, it would have been a Manitoba family tax benefit. So we're getting into the part where you have to do these religiously to see what happens, because these numbers can start to add up really quickly as your family gets bigger. All right, that's going to bring us back to the tax return. Total tax payable was $13,855.52. Total that he did pay, $16,536, and that is a refund of $2,680.48. Now, just in case you were wondering, if he had done this return on his own, he probably would have done a calendar year. So let's assume he's a very sophisticated taxpayer who can do medical expenses, but he doesn't know that he can change the year. So he knows about the home accessibility amount, but he doesn't know that he can change the year. What would have been different on his return? So I'm going to show you what the results would be for what most people would do if they did the very best they could, but didn't know how to change the year. And in that case, if I only claim the medical expenses for the calendar year, I still get the stair lift, but I lose the really nice September 2020 receipt. The difference on the tax return is about $154. So you can see very quickly making good decisions on medical expenses and for dependents, and knowing your caregiver and disability amounts can make a very big difference on the tax return. Even more than that, most people would not know about the home accessibility amount or wouldn't know that you can claim it twice. So let's say if I took that one out, what would we get? Maybe claim it as a medical expense, but not as a home accessibility amount. Notice his refund went down a bunch more. So all of these things that can add to the return, but you have to know to ask for them correctly. Knowing this chapter usually results in a good tax associate getting a better result than most people would do on a tax return. All right, we need a break. We're going to take a long break. So we're going to break until 10:30. We're going to come back to do the self-test and start the next chapter.